Good afternoon. My name is Tero Huovinen and I'm responsible for Kemira's investor relations. It is great pleasure to be here in London, and on behalf of whole Kemira management team, I would like to welcome you to our Capital Markets Day. Kemira is over 2 billion euro company focusing on water chemistry. We offer our customers water quantity and quality management related products and applications in 3 different segments, namely paper, municipal and industrial, and oil and mining. ChemSolutions is the 4th segment, selling specialty chemicals for food and feed, chemical and pharma industries, as well as de-icers for airports. The theme today is Fit for Growth, a restructuring program launched in the end of July this year. In various presentations, we will tell you what is all about the program, and besides the CEO and CFO presentations, you will hear a presentation from each segment head and also region heads of Asia Pacific and South America. We have also reserved plenty of time for your questions, and you get a chance to ask after each presentation, but also during the breaks, and then after presentations we have breakout sessions where you have a even better chance to discuss in more detail with segment heads and region heads. We are webcasting the event, and for those of you who are following us through Webcast, you have also a chance to ask questions by writing the questions in the Webcast tool. But with these words, I would like to leave the floor for today's first presenter, Kemira's President and CEO, Wolfgang Büchele. Please.
Thank you very much, Tero. Good afternoon, ladies and gentlemen. Can I have also the slides on the screen, please? Kemira today is well underway to deliver on our financial target, EBIT return of 10%, as well as to deliver with respect to profitable growth. When I joined Kemira at the beginning of February this year, I had the opportunity to talk to plentiful of people, and it became very obvious that the company is rather complex on the one hand, but also very much Helsinki-centric. The management team and myself agreed rather quickly that we embark on 3 strategic priorities which we are going to address. The first one is to improve the efficiency of the company, which factually means to simplify the company. Secondly, obviously, the growth in the emerging markets, which we all experienced over the last years and which we currently still experience, was not followed by Kemira. We therefore want to substantially grow in the emerging markets and strengthen our presence there. And thirdly, we want to sharpen our strategy in order to enable above-market growth. Kemira in 2008 embarked on the water strategy, which is great and was one of the key reasons why I joined the company. However, it was not fully made clear where we want to play and where we don't want to play. And therefore, we have seen the need to clarify that further and to really also sharpen the profile of Kemira as a result of these strategic undertakings in the course of the next months. Over the last quarters, and you are aware of these figures, Kemira was stagnating with a declining profitability. So therefore, there was a need to take more stronger action in order to get the company back on track also from a performance level. This was the trigger to come out with Fit for Growth, which we announced in the course of our Q2 release. And in this afternoon, you have the opportunity from various of my colleagues and also from the CFO to get more insight how we are progressing, to get more insight what we are doing under Fit for Growth in order to fully understand what our plans are in the course of the next roughly 1.5 years to finally in 2014 for the first time deliver E10 for the full year. I will also give you some indication on where we are working and what we are doing in order that you can fully follow up in our quarterly communications in the future how we are progressing in this respect. The first step, which obviously is well known to you, but will come to life in or on October 1st, is a new organization. We have decided to simplify the organization on the one hand, which means we are taking organizational layers out to make the organization faster and more agile, but at the same time to decentralize the organization in a way that decisions, business decisions, can be taken in the regions rather than everything has to be escalated to Helsinki. Therefore, effective October 1st, each and every segment will have regional business units or regional business managements taking care of the business in the respective geography with full P&L responsibility. So the decisions can be made where the customers are, can be made where the markets are, and therefore we are much more responsive in comparison to what we are today. Myself, as well as the segment heads, will focus largely on strategic leadership, setting the framework and helping the organization where help is needed. So in a nutshell, the P&L of a segment which exists today will be broken down in 4 respective regional P&Ls, which then, as a sum of the parts, come back as a segment P&L. So overall, there will be no change, but the whole responsibility will be one level lower, and therefore the agility of the organization will come up and will improve substantially. This is, by the way, not a completely new invention. There are many other companies who have established these type of business unit-driven organizations many, many years ago. So that's why the proof of concept of this organizational setup has been provided by other peers already in the past. The E10 margin is the prime target which we now want to achieve rather short term. You all know that since many years Kemira has targeted to achieve and deliver E10. We have now with Fit for Growth the determination but also the commitment of the management team to deliver, and we are ready to be measured accordingly. We have announced that we want to save 60 million in cost in the course of this project, and approximately 50% of these cost savings are coming from headcount reduction. You might recall we've announced that globally we will reduce up to 600 FTEs, and the respective mostly redundancy payments will be the cash cost of the program, and savings will be in the range of 30 million from this measure. We also said that we have a rather complex manufacturing network, so we want to consolidate our manufacturing network, and that will bring some 35% of the 60 million savings. And last but not least, leaner operation, and I will show you in a few minutes what that is all about, will bring another 15%. So altogether, Fit for Growth is not a fancy idea. Fit for Growth is a fully fledged program with a respective program management office in place to literally follow up on these three main streams, which again are then broken down by a large number of individual measures which are implemented underneath these three major headlines. We will have, as obviously the price tag of this program, overall restructuring costs in the range of 85 million. That is also a published figure. Some 35 million of that will be the cash cost, and that, as I said, is largely related to redundancy payments. 50 million will be asset write-downs and other write-downs in the context of the optimization of the company. The co-determination negotiations with the employees are currently underway. That's why I don't want to give you too much detail in this respect, because I don't want to interfere into running discussions and I don't want to preempt anything. But we are talking roughly of up to 500 people in Europe and around 100 people in NAFTA. Our new organization is fully designed and will go live on October 1st. We have already started to announce in South America and APAC, and we will continue with our announcements at the end of September in order to be able to start on October 1st. We also will then change the reporting structure. As of January 1st, we will report 4 segments. The CEO office will be abolished with the introduction of the new organization, and that means the 4 segments will be the full profit-bearing units of the company, and that means there will be no other whatever costs which are then disappearing somewhere. You will get the full P&Ls for the segments, and the company, the group, is again the sum of the parts of these 4 reporting segments. Obviously, we will provide you with pro forma data in order to give you a comparison prior to the Q1 result presentation somewhere in April next year. Let's talk a little bit on our asset footprint. I said a couple of times before, we have currently 74 manufacturing assets, and that is for an overall revenue of 2.2 billion euros on the rather high side. Therefore, we have started to categorize our manufacturing sites. Categorization means that we also define clearly where we want to invest, at which locations we want to invest in the future, and where not. And one of the drivers for investing in the future is clearly the availability of raw materials. That is a key element for chemical manufacturing going forward. We, at the same time, are targeting to optimize our manufacturing cost, because obviously efficiency improvement is the rule of the game in the chemical industry, and we have to live up to what our peer groups are delivering on an annual basis. So with the consolidation of our manufacturing network, we will also obviously reduce manufacturing costs and increase our efficiency on the manufacturing side. And we have, at this particular moment, 14 sites under consideration for closure. So obviously, again, I don't want to go at this moment into more details which side this might be or will be, but at least that you have a more detailed picture of what we are planning. So 14 sites are currently under review. If you look to the picture, again, this is mostly referring to Europe and to North America, because historically also by a number of acquisitions which have been made in the past. We have the highest number of sites in these two geographies, whereas in Asia Pacific and South America, we want to continue to build. I said 15% of our cost savings are supposed to come from a leaner operation. Now, we want to standardize our processes, which we use within the company, and we want also to reduce the complexity of our portfolio. This together, again, increases speed, increases the agility of the company, and makes us and positions us even better towards our customers. Just to give you a flavor on what I mean when I talk complexity. We have at this point in time more than 5,000 so-called stock keeping units, which means this is a product plus a packaging, being it a barrel, big, small, being it bulk, whatever. 90% of our sales, however, are generated with just around 1,000 SKUs. So put it the other way around, 4,000 SKUs, a hell of a lot of work, is generating just 10% of sales. And if you go to the profitability, it's not looking any different. So there is room for optimization, and this is now underway. It's getting even more interesting when you look to the customer situation. We are serving at this point in time more than 12,000 customers globally. From these 12,000 customers, 90% of sales are literally done with 2,200. So in other words, approximately 10,000 customers do not contribute much. Now, we do not want to give up on these customers. What we want and what we are looking into is to establish an intelligent channel management where we can keep the customers on the one hand, but delivering them, servicing them, not directly, but via service partners. So this is another opportunity where we are heavily working on to segment our customers in a better way and then put the respective service levels and channels into place. We also are looking, obviously, in the context of this optimization to reduce logistics costs, and ultimately, when you have less changes in manufacturing, ultimately even maintenance costs. So this so-called complexity cost is contributing approximately 15% to the total cost savings, or roughly 10 million euro. We have, in May, started a process which we have announced that we want to sharpen our strategy. And we had, in line with what we have announced, the first rehearsal with our board of directors in August this year to get initial strategic guidance on how to develop further. In the first step, we have obviously looked in particular into how do we see the market development going forward, and how do we see our competition, how do we see competition to change over the years. We have looked into our segments, we have looked into the regions, R&D, and M&A. Based on the guidance we have received in August, we are now working on the detailed strategy proposal as well as on risk and contingency plans, which we then, at the end of November, will discuss in the second strategy rehearsal with our board. And then, based on the guidance we get there, we will finalize the strategy and come up with a strategic roadmap, including all measures which are required to make this strategic roadmap happen, as well as with a strategic business plan. We are seeking in the board meeting in March the approval, and we will guide you on the results of our sharpened strategy in the presentation of our Q1 results in April 2013. Now, obviously, this is not a new strategy. It is, as we said, a strategy in the water quality and quantity management space where we are sharpening our portfolio, where we are sharpening our presence and our profile in order to clearly determine where we want to play, but also state where we don't want to play. The playing field itself with water quality and quantity management has been largely defined. We are focusing largely on three areas. We are dealing with the growing concern of our environment, water-related issues in this context. We are dealing with mitigation of water scarcity, and we are helping to solve the ever-growing energy and minerals and metals demand of the globe in a sustainable manner. In all these three pillars, water plays a major role. Therefore, the overall water market in this playing field is approximately 500 billion. Now, this is everything from chemicals to services to equipment to installation, construction, and so on and so forth. In a nutshell, the relevant market, the accessible market for us at this point in time accounts for 26 billion euros. Now, obviously, we have currently sales of 2.2 something. There is room for growth. We have clear competitive advantages. Our accessible market, and I will give you some flavor to the details of that, is expected based on our own assumptions to grow until the end of the decade on average by 3.3% per year. We have a market share at this point in time of 8.5%. 40% of our business is what we call water quality and quantity management process chemicals. So these are chemicals which are used to either reduce the amount of water needed or to improve the rate of water that can be reused. Close to 40% of our business is related to water treatment chemicals. This is either the manufacturing of drinking water from raw water, to a certain extent the manufacturing of processed water for industrial applications, but largely also the treatment of wastewater, being municipal or industrial. And then we have roughly 22% of businesses' revenues which are non-water quality and quantity management related. That is largely related to ChemSolutions and to a smaller part areas in the paper industry which have nothing to do with water, but nevertheless are helping us to be a leading player with focus to the paper industry. We are today one of the leaders in the paper industry, and we want to stay the leader or amongst the leaders in that field. So we clearly commit ourselves to paper. We have capabilities, and that's one of the core strengths in comparison. And I was asked before, what are you doing with the multinationals getting ever more bigger? We have the capability to tailor products, which these guys typically don't do. We can do that. We have the expertise, we have the respective R&D in place, and we have the manufacturing know-how. So we have a plentiful of room to play based on this capability. We have a strong innovation platform, and last but not least, our quality products are well accepted in our customer base, and we are considered a reliable supplier, which is relatively trivial if you hear that, but it's very vital when you think about what processes we are dealing with. A paper or pulp mill today, if we mess up with our chemicals and we create shutdowns of a day or two, that's a huge loss. If we mess up in providing our chemicals for water treatment, the respective municipalities are violating the regulations. So in other words, this reliability is actually rather relevant in the industries we are dealing with. And we see this as a key strength in comparison, especially also to some of the multinationals, who are rather inflexible. All our 4 segments, as we want to address them in the future, have a clear role in the Kemira portfolio. Paper has a strong position and a strong product portfolio already today. We are growing, and we plan to grow largely in South America with pulp, and in Asia with paper chemicals. But we also want to participate in the ongoing consolidation of the paper markets in Europe and in North America. So we feel that this consolidation, based on the position we have already achieved today, is a great opportunity to even strengthen what we are today. Municipal and industrial has a different profile. We are today in a very strong position in what we call the standardized water treatment chemicals in Europe and in North America. In order to be successful, especially in the emerging markets, investments and a largely renewal of the portfolio is required, and that will be addressed when we sharpen our strategy. Oil and mining, you all know this segment was established only in 2008 and has delivered greatly ever since. Also from a EBIT return perspective, we are well positioned in the mature markets, and we are currently underway to penetrate the emerging markets where more and more focus, not just on oil and gas, but in particular also on mining, takes place. And finally, ChemSolutions is a business which we are driving towards a more and more product-driven approach, focusing on formic acid, where we behind BASF at this point in time are the global number 2 in the market, and we see focusing, narrowing down this business, a lot of potential to improve and sustain for a long-term high profitability level. Our environment is competitive. Nevertheless, as you can see here, and I don't want to read that all, we have very interesting market shares in the relevant markets. And we play in a field where, except in the municipal, where we have a fragmented competitive landscape, we are playing in a field where a limited number of competitors is active. Consolidation has in part taken place in the past. However, consolidation will continue, and we see quite a lot of opportunities to benefit from that. We, therefore, are committed to continue to strengthen our market position in paper. We want to grow in the, for us, most prominent areas of the oil, gas, minerals, and metal market. But we also want, as I said a couple of times, focus on sub-regional segments in the emerging markets. So we will not go with everything everywhere, but we will play where our strengths are, and we will be more transparent on what that means when we talk on our sharpen strategy in April next year. We have more or less at this point in time 8 global competitors we are monitoring very closely, and we are also developing scenarios what these folks are going to do in the future in order to be able to preempt moves rather than to be caught by surprises. We clearly have in the oil and gas business a very intense competition. Everybody wants to play there. This business is fast growing. It attracts a lot of new entrants. But nevertheless, we've meanwhile established a solid position which enables us to act as a growth platform in the years to come. So overall, we feel rather strong in this competitive landscape and have a lot of opportunities in the next 8 years to develop this position further, and to do that, just to be clear, on a profitable basis, rather than just to grow for the sake of growth. Now, where is the largest growth from a market perspective coming? This is a rather busy slide. First of all, this is, I would suggest, not a big surprise, but for all our segments, the biggest growth comes from South America and APAC. And what you see here is, on the one hand, the growth of our accessible markets in the respective geographies in light blue, and in dark blue you see basically the underlying GDP growth. We have now assumed, and you can argue back and forth and up and down, what is the GDP growth for the next 8 years. We have, from the various sources, taken a consensus of 3.4%. In South America, we expect 6 to 7% being the GDP growth, and in APAC, we expect also the GDP growth to stay in the range of 6 to 7%, being largely driven in APAC by China and to a certain extent by India. We have in Municipal, as I said, still the task to renew portfolio in order to meet the requirements of these markets. That's why we see currently that our accessible market is growing in these geographies below GDP, because we do not yet have to the full extent the portfolio needed for these geographies. The other interesting segment for us is oil and gas, because oil and gas is not just overproportionally growing in the emerging markets, it also continues to grow overproportionally in the mature markets. So therefore, for us, this business is giving not just opportunities by going into new territories, it also enables us to leverage the position we have already achieved today in the mature markets, and we want to leverage that, to drive that home in the next 8 years. Research and development is the basis for our innovation platform and one of our core strengths. We have at this point in time some 350 scientists in R&D, focusing on new product development, focusing on product improvement, but also focusing on what we call developing applications which either improve energy efficiency at our customers or help them to run their operation with less energy and or with less water consumed. We spend around 1.8% of group revenues for R&D, and going forward we want to keep roughly the level at this figure, because we feel for what we need to do, what we want to do in order to support our growth ambitions, that is the right corridor. We have a rather strong IP portfolio. We are trying to patent our developments in order to embark into literally protected arenas, because that is definitely also a way to improve the return on your investments and on your activities. And we have at this point in time roughly 1,350 patents pending, granted, or underway existing. We are focusing our R&D on the 4 centers. We have discussed that before. Clearly, the headquarter for R&D, so to speak, is in Finland, in Espoo. Our second largest R&D center with a very strong focus on oil and gas, but also on mining, is in Atlanta, in Georgia. We, beside that, have 2 R&D centers, one in Shanghai and one in Sao Paulo, that focus on the specific needs on these emerging markets and work very closely with customers more on the D rather than on the R side. R is largely done in Espoo or in Atlanta. D, especially for the emerging markets, is done either in Sao Paulo or in Shanghai. We are also, alongside now with the manufacturing consolidation, starting to improve our manufacturing technologies. There is also a lot of room to further improve our processes, because at the end of the day, still manufacturing is one of the capabilities which are key in the chemical industry. And we want to foster also on that in order to be able to deliver not just state-of-the-art high-quality products, but we want to deliver state-of-the-art high-quality products from state-of-the-art processes which also meet sustainability criteria. A question which I'm always asked, how about M&A? Are you now going out for the next shopping spree? Are you trying to buy whatever is around? And the answer is clearly no. Our immediate focus is and stays on Fit for Growth and to deliver the results of Fit for Growth. Beyond that, and I've communicated on that before, we have clear criteria when it comes to M&A. We only are interested in acquiring if we either can strengthen our market position, so if we can outbranch into geographies where we are still weak at this pretty moment, or if we can gain competencies which we feel we need but we don't have at this point. These are the driving forces to look and ultimately select which targets are of interest and what is not of interest to us. So in a nutshell, buying more of the same is nothing we are even looking at. Secondly, we have very strict profitability criteria when it comes to acquisitions. The acquisitions must enable us to be EBIT accretive in the second full year after closing, meaning we are not prepared to overpay. So we are prepared to pay a fair value for an asset. If we can get it for that, it's great. If whatever huge amounts are necessary, somebody else should do that instead of us. We want to pay fair values. So what does that mean for us? Obviously, smaller acquisitions, if we can gain a position in the one or other geography in the defined growth subsegments, can be considered whenever something comes around and we are monitoring the market. Should something become tangible, we will definitely communicate that. Larger acquisitions can and will only be looked at once the sharpen strategy is approved by the board. So we are not going now out to immediately start again to buy. We want, first of all, to define our strategy, that everybody understands what is the way forward. We want to deliver on Fit for Growth, to be ready for a bigger acquisition, because an acquisition also needs to be integrated. And as you could see from our manufacturing network, integration was not done to the full extent possible with previous acquisitions which took place many, many years ago. So from that point of view, larger acquisitions will only be considered at a later stage. So I hope that this clarifies also a little bit and puts into perspective how we are positioning ourselves in the M&A market. What is our roadmap, short and long term? Obviously, now the highest priority is and will stay on Fit for Growth, implementation, delivery, in order to have 2014 as the first full year with an EBIT return of 10%. Cost reduction, complexity reduction is the rule of the game. Sharpening the strategy runs in parallel. We will have in November the next rehearsal with the board. We will get the approval of the sharpened strategy at the end of March in our board meeting there, and we will then start to communicate also to you and will guide you what that means for us in our Q1 release in April next year. Again, for the avoidance of doubt, this is not a fundamentally new strategy. This is a sharpened strategy in the WQQM space. And then, once the strategy has been approved, the strategy has been communicated, we roll it out, and we want to grow above the market, and we feel that we have the capabilities to do that until the end of the decade. On the last slide, you see the management team. This team is committed to deliver E10 in the given period. This team is also committed to deliver growth, to deliver profitable growth in the years to come, and to keep the company from a competency level state of the art. Because one thing is important. You can push everything with a program short term into the right order. Successfulness requires that you keep that state. And therefore, we have to make sure that we are now not just getting Kemira into the right shape and move in the right direction. We have then to make sure, once we are underway, that we keep the pace, that we hopefully are a little bit faster and smarter than competition, and that we constantly cross-check what we have to do from an improvement perspective in order to stay state of the art. And this is what this management team is committed to deliver to you, but also to deliver to ourselves, not just because we are also shareholders of the company, but because we are also responsible for employment. And if we are successful in the long term, we also secure long-term employment. Thank you very much.
Thank you, Wolfgang. We have now time to take questions. Is there any? Please wait for the microphone and state your name.
Yes, in your assumptions for global growth, I know it's very difficult to get the right number, but what other assumptions do you use to get to your 10% EBIT besides just, because this means that all the cost cutting will come through, besides, of course, the layoff payments. But is there anything, pricing, getting market share, anything else, any assumption that we don't know about?
We have, for this exercise, not considered price increases as a driver for E10. We want to largely deliver E10 based on the efficiency measures. Because we felt at this point in time, it's very difficult to predict how the economy is developing. And we do not want to go back and tell, oh, by the way, the economy fell apart, and then everything is completely different. Now, obviously, if the world changes dramatically, this has an impact. And then we have to revisit. That's what we are doing as part of our strategy work. We are developing scenarios. What's happening if the oil price is suddenly going to the roof? Or if the growth in China would fall apart? That's not yet factored in.
So assume flat pricing.
We are currently assuming that we ramp through what raw materials are bringing to us. So in other words, we are assuming flat margin, not flat pricing, flat margin.
Yeah. And looking at benchmarking yourself in each division, do you have sort of best-in-class competitors that you look at that you want to be on par with or above?
We are always looking, and we have started very intensively to look at our competitors, and we have defined for each and every segment which competitors we feel are the most relevant to us and which we should look as a benchmark. We are doing that, but I don't want to speculate on competition in a public audience. But we are doing that.
Hi, Fabio Lopez from Bank of America Merrill Lynch. How do you compare this new restructuring plan with the restructuring plan that the company had before? It had 25 plants closed. It had a target before on the EBIT margin that was not achieved. So what is different this time?
I think, without going into too much detail, a lot was achieved in the past. But at the same time, the margin level of some of our portfolio was fading away. So we could not keep the margin level. And that's why the benefits which were achieved with the restructuring program were partly eaten up by a deterioration of the business. And that's why I said we have underlined flat margin level. So we do everything to keep the margin at the current level rather than to see sacrifices there. So we are really looking very diligently, beside focusing now on fit for growth, also that we are not losing at the customer interface. And the RBUs, the key structural element of the new organization, help us a lot in this context.
Any more questions? Here?
Thomas Foda, First Bank. I have a question on incentives. Your management team, how do you control that, or how do you push it forward? Are there any special incentives in place in the case the program will be successful?
Well, first of all, the incentive scheme for the management team is not set by myself. This is set by the board of directors. I think we have a very powerful incentive scheme in place, which is largely linked to shareholder value creation. And as the management team, all the members of the management team are at the same time shareholders in the company, we are fully aligned when it comes to this delivery. Secondly, the incentive elements are typically awarded in shares rather than in cash. So that means that's an additional trigger for us to deliver shareholder value and focus on shareholder value.
Sorry, could you please wait for the mic for the webcast?
Eric Carlson from AKO Capital. Which division do you think you will have to work hardest for to improve margins in?
That's a question I would like to answer twofold. The biggest challenge, obviously, very short term, is in M&I, and it is in ChemSolutions. And if you look to the last quarter's results, this is pretty obvious. However, the situation is a different one. For M&I, the challenge for us is less so in the mature markets. We can achieve that rather quickly. What I said before is that in order to be long-term successful also in the emerging markets, we have to renew the portfolio. We have to invest. That's the more challenging part. So the innovation platform has to focus largely on renewing the portfolio. The, so to speak, efficiency part has to focus on the mature markets. But these two segments are the ones we are addressing quite intensively, and the colleagues, Hannu, Virolainen, President of M&I, and Frank Wegener, responsible for ChemSolutions, will also give you a flavor that we have taken that up. So we are not waiting now. We are not sitting there and hoping that everything will improve out of itself. We are taking, so to speak, our fate into our own hands.
Right, and maybe one or two questions, please.
Yeah, thanks. Martin Owens, JP Morgan. Just sorry to return to this 10% EBIT margin target, which obviously seems attainable now with the cost-saving benefits coming through by 2014. Just in simple terms, this has always been an issue for Kemira, this magical 10% target, and yet it does seem, by the sort of industry standards, to be quite a low number. And is that a function of the nature of the products you sell, and therefore the sort of resistance from customers to price inflation, or is it something else that we're missing?
Well, I think I don't know why this 10% has been now put with such big letters to the wall. First of all, I think, and that's my way of looking at it, in the chemical industry, the 10% has been a figure which was always discussed what you have to deliver across the cycle in order to be long-term sustainable. And that's why for us now the 10% is the first and the immediate level we want to achieve. What's possible thereafter and what's not possible thereafter, I don't want to speculate now. Let us first deliver on E10 and then think about what other room do we eventually have. But the 10% to me is neither a question of shareholders driving it, nor a question of this is a big target which is on the wall and we have to achieve it. This is based on my 25 years in the chemical industry, the basis to be long-term sustainable. And that's why we are striving to get there.
And then perhaps just one more question, and then we have to continue. Oh.
Thank you. Alex Scott from Chemical and Engineering News. You mentioned about the 14 plants. Is it definite that they'll all be closed, or and do you have an idea how many? And with regard to the job cuts, obviously you mentioned the 600 till now. Do you have a rough idea in the future of how many from the plant closures?
Well, obviously, as I said, I do not want to preempt running co-determination negotiations. But I would at least give you the following guidance. As we are intensively reviewing 14 sites, and you've seen the picture I've showed you with respect to the regional distribution of the sites, I don't think I'm overstretching if I guide you in the direction there is room for consolidation, and you will see this consolidation. But I don't want to get more specific at this point because the negotiations are still ongoing. And we will let you know whenever something is finalized, then we will start to communicate. But we are taking that very serious.
Thank you very much, Wolfgang.
Then I would like to hand over to Petri Helsky, who gives you, as president of the paper segment, more insight into this fascinating business.
Thank you, Wolfgang. Good afternoon. I'm now 4 years in this current position of mine, but it so happens that Wolfgang said he's 25 years with chemical industry. I'm exactly 20 years because I got my first job with a chemical American company exactly 20 years ago after graduating from university. So it's close to these anniversaries. And it's my 5th Capital Markets Day, and I'm happy to be for the first time in this context here in London. It's also nice to see many familiar faces from either CMD or from other contexts. It was especially nice to see one person who we went to serve military service together, who I have not met in the last 26 years. So I had to come to London for that. Let me now go to this fascinating topic that Wolfgang was referring to, and I would want to tackle this in 3 parts. first part would be to tell something about our current already very strong position in this business. Second would be to shortly go through what these fit for growth consequences would be for paper. And thirdly, and probably most importantly, I would go through how we are able to answer to the title of the presentation. So how will we be driving growth? Since for some of you this business of ours might not be that familiar, so very shortly I recap what we actually do. So our customers are really the pulp and paper producers, and we really serve in all regions the major players, whether they are producing pulp or whether they are integrated pulp, paper, board producers. We have customers in tissue, in packaging and board, in printing and writing, and in all different types of pulp. Our revenue last year was about, in round figures, about 1 billion euros. We really are one of the top 3 key players in this pulp and paper chemical business. Our market that is accessible for us is order of magnitude of 26 billion euros annually, but we have limited the relevant market of that to roughly 7.5 billion for our sake. We have a very comprehensive product portfolio covering the pulp process and especially the wet end of the paper manufacturing process. And this water link is very evident in pulp and paper production, because it is really one of the most water intensive industries that there is. There is a poster in the forum area showing an example of a paper machine, and it's interesting reading and absolutely fascinating for each one of you. So you better have a look during the coffee break. If you have any questions, feel free. So what are our regional positions then? If we start from the west. So in North America, we have traditionally a very solid position, both what comes to pulp, especially the process chemicals part of pulp production, as well as the wet end part of the paper production. And this really gives us a good basis to further develop the business from. In South America, we are more of a newcomer, so we have less of a full scope of offering at the moment. We are strong in pulp and in especially sizing, but we are expanding our offering now to other parts of the process. And jumping then over to APAC, it's very similar in that respect, the situation for us, that again there it's more of a new territory for us, but we have already been there since years, and we have a very solid basis again to develop the business further from, because we already are very strong in sizing and certain other paper chemicals, whilst the pulp chemical part, again by choice, we have left outside our scope. And finally coming then to Europe, where we have the strongest overall offering, we have really the big pulp chemicals in addition to our paper wet end and also the pulp process chemicals part. Here you see just examples of market shares, partly in South America, partly in China. And the key message from this slide is to say that this Nanjing production site of ours will really drive further growth in Asia, especially in China, but also in other parts of APAC. And we are investing into additional capacity also in South America. We have currently ongoing hydrogen peroxide expansion project in Uruguay. And as Wolfgang was also saying, what is true for the group is true for us as well, that big part of our sales is coming from the mature markets, and it will be so in the future as well, but the big growth we see coming from the emerging markets. When we then have a look at the development of our business in paper for the last 4 years, we started in 2008 from a pretty poor EBIT level of just above 4%. And we have been developing that rather continuously from ever since, and we have taken many different measures to achieve that. We have been divesting certain businesses that we felt that we could not make profitable and which were really not in the core of our offering. We have been closing already in the last years several sites. More than a dozen sites have already been closed. We have been continuously shifting our focus more to serve the wet end part of the paper offering. Still 3-4 years ago we had a broader offering, partly also including, for example, pigments and optical brighteners, but we are more looking really now to focus on the wet end, and more also shifting resources to serve the growing segments being packaging and board and tissue. Then longer term there will be also potential business opportunities coming from bio-based materials also for green chemistry, but that is a bit further down the road. Then the consequences or the savings from this Fit for Growth for paper's part, they will exceed 20 million. It's also just mathematically as such because we are 40+% of the group, therefore when the group saves we get a lion's share of those. And of course, as Wolfgang was already mentioning, these savings come from leaner organization, simplifying, again cutting for example these SKUs, further manufacturing network optimization, and big part of the energy savings come also then for paper because we are by far the most energy intensive segment of Kemira. Then looking at the market, there's plenty of tables here, but let's start by looking in the middle, the two bars. You see that the mature markets, they have a rather modest growth in the coming years. They are not declining, but they are not rapidly growing either. Whilst then the emerging markets have order of magnitude of 5% CAGR growth, and that of course means that there the opportunities are greatest, and the opportunities are such that in APAC it's really in the paper and board production that we have the chances, whilst in South America again it's in the pulp side. And looking then at the pie charts, you see the P&B being packaging and board and T&S being tissue and specialties, that they have by far the biggest growth, whilst printing and writing remains more or less stable in the years to come on a global level. This labyrinth or maze is not meant to be dived in detail. The purpose of this is really to show that we have a comprehensive product offering which we can really back up with the application know-how that we have. And this wide competence that we have in pulp and paper application is really the key competitive strength that we have. Then one could add perhaps here that the ever-increasing amount of recycled fiber and also the trend towards what is called lightweighting, so to have lighter package but with the same strength properties than a heavier package would have. All that done in order to save on the fiber cost, which is the single highest cost item for the paper or board manufacturer. That really creates opportunities for us as a chemical supplier, especially what comes to strength and sizing chemicals. The role of pulp chemicals has been occasionally asked, and for us it really also allows us to be really a strategic supplier to the major pulp and paper groups, because we have such a big revenue then with these groups that when they are doing their simplification and reduction of their suppliers, we sort of automatically, one could say, fall into that category because of our high total revenue with these groups, and that enables us to develop also the other process chemicals part. And then again, not going into the details, but if we look at the different customer decision criteria, so we as Kemira are very well positioned on the pulp side as well here on the paper side. The decision criteria are not exactly the same, and the main difference is that on the paper process side, this mill service and application support are really by far even more important than for pulp. So, to summarize, the Fit for Growth measures will bring us more than 20 million cost savings, and then looking at the hows, so why we are able to grow, is really, first of all, our existing very strong position that we already have, then the capabilities that we have, both on the product side and the application know-how, on the production side, on our geographical reach side, and finally, it's the dedication. We as Kemira, we really are committed to pulp and paper, and we are committed to grow and develop this business. Thank you very much.
All right. Any questions to Petri? Please, here.
Panu Laitimäki, Danske Markets. To capture the growth in the pulp production market in South America, do you expect to have to make big investments there to build new chemical islands or so?
If we want to partake in some of the coming big projects, then our existing capacity is not enough, and therefore to take part in those in the coming years would really require some investments. We do have some chances. Well, I was already mentioning, for example, this expansion of ours of the peroxide capacity, which is not a huge investment, that allows us to grow in the pulp field already.
All right. Please, here.
Thomas Svoboda from Firstbank. A question on your exposure to emerging markets and how you want to catch up there. Is this something you can do organically, or would you need to do more M&A to increase your exposure to those growth markets?
First of all, I think Wolfgang already covered the M&A part to rather high degree, but I would say that we really can grow organically in the emerging markets. In paper, we have such a basis already to stand on that we can have rather good growth just organically.
And maybe then as follow-up, what would we need to see from you to be convinced about stronger growth in emerging markets? Would it be that you will be spending capex as you already mentioned, or do you have already the capacities in place, the steel in place to grow?
What comes to capex spending, we are currently investing in the Nanjing production in China, and that is a great stepping stone then to build on in APAC. And then for the rest, I would refer to the previous answer of mine, what comes to South America and participating in the pulp chemical field.
Right. Please.
Artemelis KCB in Schilda. As you showed on your slides, and probably everyone knows, packaging and board and tissue will be, so to say, relative winners in terms of growth. Do you expect this trend to support your profitability development within the division?
I think so. We have really, when you show or when you looked also, this is a bit slow going, but you saw the EBIT development that we have had. That comes really to already high degree from the fact that we have been focusing more on these packaging and board and also tissue.
Okay, thank you.
Okay.
Markku Järvinen, Evli. In the previous presentation, it was said that in paper in Europe and North America, you would look to improve profitability through M&A. Could you elaborate a little bit on the potential there and what you would be seeking?
This is very much linked to what Wolfgang was saying. So Wolfgang's exact words were that we are looking into consolidation, but at the same time that the time is not there now to do the M&A. Would you like to build on that, Wolfgang, any more, or?
If I can just continue, consolidation in this sense means that you would be looking into acquisitions in any case, or is that?
Potentially we would at least keep our eyes open and see what is out there and to what kind of prices.
Yes, perhaps
Let me give you one hint. When consolidation is underway, that always is also an opportunity to gain market share. Because the respective company that has put something on the block is less committed to the respective market. And we are also trying to benefit from these opportunities.
One of the other points is proximity of Kemira's plant to the customer is very important. If we look at your addressable market, it's a third emerging markets, a third Europe, and a third US. Then if I look at your revenues, it's 55 EME, etc. So what needs to happen? I know that you're closing down a lot of factories, etc., etc. But does it mean that from an EBIT margin point of view, that's what is going to drive your investments to get closer to those new clients in emerging market? Or is it more return on invested capital? Because you might need to invest less capital maybe in an emerging market than in a developed market. Why is EBIT margin more important than return on invested capital?
Let's say, I would state it like that the proximity to customers is important from many a point of view. It's first of all that you are more credible as a supplier if you have production in, for example, APAC. So it's sort of a must in order to be a seriously taken supplier. Secondly is, of course, the total cost, which is then a balance of the producing entity and its cost and size, whilst the freights, of course, are then the downside if you have only one central location, for example, serving the whole globe. And then it's finally also about the reliability aspect that also Wolfgang was referring to. So especially for the big volumes, if we think of pulp chemicals, for example, and also the structure that especially the South American pulp market has, then in many cases it will require sort of a chemical island being then very proximate to the user.
All right. Thank you very much, Petri. And let's take another next presentation, Municipal and Industrial. Hannu.
Yes, thank you. Thank you, Tero and Petri. Yes, indeed, my name is Hannu Virolainen. I guess I'm today the third speaker here who has 20 plus years experience in the chemical industry. And I've been holding this M&I position now since November last year. I want to share with you today few key points here regarding our market situation, our market position, and on the other hand, elaborate further on our Fit for Growth program, which is really the key program to enable us to make a positive result turnaround. Our business is very simple. We are manufacturing and selling water treatment chemicals for municipal and industrial customers for their raw and wastewater treatment applications. We are operating in a business which is where the market size is about 7.5 billion euros, while as our current size is 665 million euros. Our two key product lines are inorganic coagulants and flocculants, where we have a very solid and good supply position. The key driver for our business is also a very simple one. It's the basic need for water. All of our customers have water going in which needs to be purified either for the drinking water standards or for different industrial water standards. All of our customers also have wastewater which comes out and where the solids needs to be separated, which in turn means that there's a lot of sludge coming out, which also need to be treated and made fit for the disposal activities following the process. In terms of product groups, the two main product groups are coagulants and polymers, which are valid and which are being used today in the conventional water treatment facilities and installed base, which is today about 95% of the total water treatment installed base globally. So more than 95% of the water is being treated with the conventional methods, implying large settling ponds and implying different kinds of filtration steps. Our customer base, municipalities, consist of there's maybe three kinds of customers there. Large cities like Montreal or Sao Paulo or City of Los Angeles, who are purchasing their water treatment chemicals directly. There's also purchasing cooperatives like Aquafin, which is a constellation of different water treatment entities in the Flemish part of Belgium, or then private and privatized utilities like Thames Water here in the UK or Veolia globally. On the industrial side, we have our customer base consists of a variety of industries, of course excluding pulp and paper and oil and mining, which are handled by our sister segments, but the remainder, meaning food and beverage, metals, pharmaceuticals and constructions, to name a few examples, as our customer base there on the industrial side. And again, the common denominator for all of those customers is that they got water going in, water coming out, and there is sludge which needs to be treated. The total market where we are operating, the size of that one is about 7.5 billion euros, and we need to analyze it per different, there's four relevant product groups in that what that market consists of. We have polymers, inorganic coagulants, where we have today a very solid and good supply base consisting of our supply position in inorganic coagulants is number one globally at the moment. We are the market leader in the inorganic coagulants and also have a very solid supply position in organic polymers. And we are actually in the marketplace the only company who has these two key product lines in the product portfolio in-house. And that implies that we can leverage the sales force efficiency clearly with versus some of our with some of our competitors when it comes to conquering the marketplace. The third important product group is the anti-scalants and biocides and defoamers, which are very much used in the new water treatment technologies like membranes and membrane bioreactors and desalination, as well as in the boiler and cooling water applications, both in the mature and the emerging markets. The final product group, which says here miscellaneous chemicals, means all kinds of basic commodity chemicals for pH adjustment and disinfection and such applications, where we today have just opportunistic position should we have a local supply base existing for those products. It's very clear that our result development has not been adequate and has not been meeting the standards in the past 3 years, and therefore we are now embarking on a very clearly defined Fit for Growth program, which will change this trend and which will lift our profitability and result up to the standard levels of EBIT 10, which we have been discussing here before. There's one common denominator. This for MSI, the Fit for Growth program consists of a number of already started and ongoing projects, and they have maybe one common denominator in them, and that denominator is simplification and streamlining, and it applies both to the manufacturing footprint of the inorganic coagulants as well as into the organization and way how we are doing the business. When we are looking at the Kemira inorganic coagulant manufacturing footprint, there's a lot of dots here, and it is also a fact that the inorganic coagulant as a nature of the product implies that the economical distribution radius is about 500 kilometers, especially in the EMEA circumstances. And that also means that in order to be present in the market, we need to have more than one plant. But it's also equally clear that the footprint today, and given especially the well-known facts of the demand reduction in some of the key regions in Europe, it's very clear that our manufacturing footprint is not optimal, and as a part of this analysis work, what we have been doing and what we are doing there, it's very clear that we will close several plants and several sites, both in EMEA and in North America. But as Wolfgang already highlighted earlier, we will not go, I cannot go, and we cannot go more in detail that which are those individual sites, but we will communicate about that as we progress with the analysis and progress with the negotiations with the unions. The other side of the coin here, of course, is it's not only cutting sites, but we are working in Germany and in Spain to develop. We have 2 CAPEX investment projects, which has one common theme in them, and that's a fact that we are building a site which is integrated to the byproduct raw material source together with biomaterial science with the long-term supply agreements, which then in turn guarantees a long-term sustainable presence of that production unit. So it's a kind of, in the manufacturing side, we are minimizing the footprint, optimizing the footprint, either by closing sites and at the same time focusing the investments and effort on those sites what we believe that will be there sustainably on the long run. The other side of the coin in the Fit for Growth program is clearly this simplification and streamlining of our activities and how we are doing business. Number of SKUs, number of organizational layers, number of customers. The 80-20 rule applies very strongly in many areas, and we are taking a hard look at how we are doing the business in that respect, and also then deciding and defining what to do with the rest of the 80% there. Streamline, handle that business with the distribution partner, reduce SKUs and so forth. And these are again already today dressed up and turned into a very clear projects with clear project management and clear deadlines and clear targets. I've been so far talking about the fit part of the Fit for Growth program. In the growth side, we need to, before addressing that, we need to understand, and I'll go back to these 4 product groups, what I highlighted earlier. In the inorganic coagulant domain, that product group is not growing very much. It's maybe growing at the rate of the global GDP in each country as it is driven by the economic activity. Polymers are growing a bit faster, driven by the industrialization, especially in the emerging markets, as well as by the sludge treatment challenge, which is an ever-increasing challenge by what our customers are facing these days. The fastest growing product groups, anti-scalants, biocides and defoamers here on the left side, are the ones where the market growth is driven by the emergence of these new water treatment technologies, membranes, desalination, membrane bioreactors, and so forth. And then the miscellaneous grow again at the rate of GDP. When going concretely, what are we then doing to capture that growth? There's two ways to look at it. One is the geographical initiatives, and there we have clearly chosen APAC as a region to go deeper, and especially there go into these new water treatment technologies which are there growing at the double-digit rates. And we are making a market entry to India with coagulants. We are localizing the product sourcing in China. We are increasing the resource base and our application expert base in APAC region overall to make sure that we are able to capture that growth which is coming from there. In the coagulant side, when looking at the product line specific growth, in the coagulant side we are making sure that our manufacturing base is sustainably competitive and keep capturing the market growth as it comes along, but we do not have any special targets there to radically increase the market shares in that product group at the moment. Polymer product lines will grow faster than the GDP and faster than the other product groups. And actually here you can see this example of the EMEA industrial growth, which has been in the past 3 or 4 years over 7% annually. And that growth has been very much driven by the polymer applications and polymer product development and knowing our customer needs and being closer to the customer. And this is the general recipe what we are aiming to utilize then when also developing and growing the business in the emerging markets, especially in the APAC area. From the R&D perspective, we have focused our efforts clearly into the new water treatment technologies and products supporting those new water treatment technologies, meaning anti-scalant, biocides and defoamers, and especially their formulations, which are then application specific and require a close touch with the customer to be able to bring to the market and make a business out of it. And we have in the past 2 years now increased gradually our R&D input and R&D expenditure and focusing it specifically to capture the growth from these new water treatment technologies, i.e. kind of a product range renewal, if you like. To summarize, we are aiming to grow by renewing our product line, increasing our exposure and increasing our business in the product lines relevant for the new water treatment technology, especially in the APAC and emerging markets. And at the same time, we are committed and we will bring home the annualized savings of 20 million euros from the Fit for Growth program with a very clearly defined ongoing action plan. I'm happy to entertain any questions should you have before the break.
Is there any questions?
Looking at the pie chart over your 4 different products, polymers, etc. If you look at the profitability in 2 years' time and you achieve your target for your group, could you break down which product would roughly be at which margin? So which one is the big driver of that margin?
It's hard to say that answer that question because actually all of these products there is a certain cycle to them in a sense. So you cannot put it. You cannot say that it's specifically coagulants or specifically polymers would be the drivers in 2 years' time in terms of the margins. But you need to take it into a perspective and look at it over the cycle. Having said that, the key point there with the Fit for Growth program is there really to take out costs out of that whole system then in such a way that this over the cycle profitability will be at the level of at the target level, which it clearly has not been in the past.
Could you indicate, for instance, is polymers from 8 to 12% and conclusions from 6 to 8%? I mean, how do they differ? How do they differ through the?
It very much depends on also on the market side. Then that if I could give you a snapshot from Finland or from EMEA, which would be different from North America. So I cannot answer that question actually. Again, only thing what I can say there is that we take costs out of the system to make sure that this over the cycle EBIT levels for the key product groups will be above 10%. And that's what we are committed to do.
Thanks. Just referring, I think, to page 37 and that chart where you very honestly show us the recent performance. In order to understand the future, we need to get a sense of what went wrong in the last 3 years on the margin and so on. Is that simply a cost issue and inefficiencies and having too many plants, or is it more that the demand, the structural market you're selling into has become much tougher?
It's but like usually in these kind of things, you cannot, or it's not possible to point out one particular reason. So it's a combination of many things, and actually all the elements what you just highlighted there are present there in some sense. One fact also what we need to remember is the thing that in 2008, those of you who have been following chemical industry longer, you remember 2008 when everything went way up. Sulfuric acid was costing $1,000 a ton or something like that, and that then pushed the market conditions in such a way that the price levels of all the products were very high, also our end products. And then given the fact that the biggest chunk of our customer base is municipalities, that of course then has been positively impacting also in 2011, 10 and 11. But that is not I mean, how to say now, this is not the explanation on anything. The fact is that we need to make sure, and we are making sure, that we are now making these structural actions which guarantee that the profit will stay over 10% over the cycle.
But there must be
maybe the microphone.
Sorry, it's Eric Carlson from AKO Capital again. There must be some simple explanations why it went from 11% to 5%, because it's a big jump, just so we understand it.
Well, it's the overall gross margin levels on some of the key product groups, and then the other one is the structurally reduced demand in some of our key market areas, including including South Europe and some of the US, some parts of US, due to the economic downturn. Those are, you could maybe say, those are the two main reasons what has happened here.
And do you feel those are now at the bottom and they can't go down any further, or?
Well, that's a question for a major requires a major economic analysis to answer that, because of course the reason why South Europe and some parts of America went down was a purely macroeconomic reasons. There, you know, the Spanish situations and all that kind of stuff. So if you can answer that question, that pretty well extrapolates then what would happen on these markets with the, say, 1 year time lag. And it's also a fact today that we feel bad about some of our Spanish customers, for example, because you have a operator there, or you have a manager running a wastewater plant. He simply does not have money from the government budget to pay for the coagulants, and or pay for the products, and he's running at the borderline of legality by running the operation and violating the permits by doing it. So it is a really serious situation there, though.
Maybe just one addition for the clarification, and that also relates to the question polymers versus coagulants. In a nutshell, the polymer market is a rather stable market, and it depends obviously on the oil price and therefore ultimately on propylene and so on and so forth. The coagulants market is a rather volatile market because, as Hannu Virolainen has pointed out, we are using byproducts of other processes. And depending whether these processes running at full speed or running at a reduced rate, the cost of these byproducts change dramatically. Secondly, the hurdle rate on the coagulant side to set up new shop is rather low. So if you want to set up a coagulants manufacturing and are willing to spend around $3 million, you can enter that business. And that has happened in the way or in the last couple of years. So a lot of these mom and pop shops have been appearing, especially in Eastern Europe, but also somewhere in the United States, on the back of the availability of large volumes of these byproducts. And that has driven market margins down. Now, obviously, with our consolidation, you saw the two hub plants, one in Tarragona, the other one in Dormagen, next to a Bayer TDI facility. That will enable us to stay competitive and stay ahead of these mom and pop shops. That's the strategy behind.
Okay.
I failed to get my question into Mr. Büchele at the end of your presentation, but I was wondering whether I could present it now as we are just before the break.
Yeah.
On your website, I noticed that there are a number of competition-related issues, and there are references to a case in Dortmund, Helsky, and Amsterdam. And I was wondering whether you could make some comment on whether Kemira has set funds aside to deal with these issues, or whether Kemira wants to settle these things. And lastly, why does Kemira not comply with competition rules?
So obviously, I cannot comment on history. I can only guarantee that as long as I'm the CEO of Kemira, there is zero tolerance for violation of any of the legal environments. Legal compliance is key for us. Now, with respect to the cases which have been announced, these have been charges brought forward to us. These are pending cases, and therefore I don't want to comment on pending cases. But clearly, and this is an assurance I'm giving everywhere where I'm asked for, Kemira, under my leadership, is fully legally compliant.
Right. Please.
Yeah, coming back to my question for your 10% EBIT target, because it's quite important that today to understand the details, how you get there. You promise that you will get to the 10%, and you say, well, you think you exceed 20 million. So how can you then manage, if you say you're dependent on the cycle, you're dependent on input prices, on raw material prices, how confident are you about the 10%? Or is that just 1 quarter 10% and then you don't know? I mean, how much is in your hands about the 10%?
Only disclaimer there is, of course, again, on this general economic cycle, that if that goes to really haywire, so that aside, we are very confident. It's not only me, but it's also our management team in the M&I side is very confident that we can reach that 10% EBIT. And again, this number 20 million, which is there, it's not just out of the air or coming through some allocations or anything like that. It's very specific itemized projects with the number price tag attached, with the clear responsible persons, with the clear deadlines to get it through, and just mathematically that will bring the number.
Yes, and just assume that everything stays as it is, and then you're 2 years through the restructuring and you are at 10%. Could you then give me an idea where polymers would be versus coagulants, etc.? Would polymers be at 14 and the others at 9, or what's the difference in profitability?
Again, I would need to again reply to that question regionally. In Europe, the coagulants would be probably a bit higher than the polymers, while as in NAFTA would be the opposite. And depends on that is again a derivative of our raw material positions on both of these product groups, as well as the manufacturing asset competitiveness as a whole.
All right. Maybe, yeah, here.
Thomas Swoboda from Mine First. I have two questions. Your access to byproducts in China, that was a problem for you over the last years. Did anything change there? Do you have enough access to byproducts to keep your costs low and to accelerate growth there?
No, we are not actually today. We used to have 4 or 5 years ago inorganic coagulant manufacturing in China linked to a byproduct setup, but that was not competitive, and we exited that, and we have not made a re-entry in the Chinese coagulant markets until now. We have only in APAC, we have the Indian coagulant manufacturing unit development ongoing. The plant will be opening up later this year, and that is situated close by to the byproduct hydrochloric acid sources. But in China we do not have that.
So this is limiting actually your growth potential in China, the limited access to byproducts.
Yes, it is. In a way you can say yes, and in a way not really, because how we see it, that the Chinese, when they are building the infrastructure for the water treatment in general, they are kind of jumping one step ahead of what EMEA did. So they are looking for the new water treatment technologies. The growth of membranes and membrane bioreactors for the wastewater is in excess of 10% in the Chinese market. And that means that the product mix which is used for these installations is quite different, and it requires clearly less inorganic coagulants than the conventional water treatment factories. And that's why we are saying that the key thing for our sustainable growth is to have a presence and develop our position in these so-called other products, meaning biocides, defoamers and anti-scalants, and the coagulants are kind of less relevant in that game.
Right, and a second question, if I may, on your municipal clients. I mean, the financial crisis is going on already for quite a while, and you find your Spanish customers seem to survive quite well with half of the water chemicals they have been buying from you in the past. Do you see the risk that over time these customers are getting used to lower levels of your product, coming around regulation with other methods, and that the volumes will never come back?
I don't. First of all, I would like to. It's not half of the volumes. It's somewhere between 10 and 20% lower volumes in those regions. So it's not so drastic that it would be half of the volumes only. And yes, the other part of your question, it's a very clear risk that they learn to live with it, and also maybe the legislative bodies are also kind of giving somewhat leeway there into those customers, that it is a real risk, and that's why we are not waiting for that to materialize. That's why we are acting on this fit for growth now, and we are adjusting our operations accordingly. And then, of course, should the market recover in those more depressed areas of today, we have built-in stretch in the capacity in our remaining key units that we can rather easily supply that.
Thank you.
Okay,
Hannu.
thank you, Tero.
I think it's high time to take a coffee break, and other refreshments will be served in forum, right? And you should be back here at 2:30 sharp.
Economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry R&D network, working together with local expertise and customer service to provide the best tailored applications for our customers. It is our heritage to treat our customers, the environment, and each other with respect, honesty, and integrity. Water is the connection. Life on Earth is dependent on sustainable use of water, energy, and other natural resources. Mainly due to economic development and the growth in global population, we are running short of all of them. This is one of the greatest challenges faced by our generation. Fortunately, a large part of this challenge can be solved through innovative chemistry and industrial process know-how. This is what we at Kemira focus on. Our mission is to help our customers optimize the amount of water and energy used in their water-intensive processes and improve the quality of their end products. This will result in an increase in production efficiency and a lower impact on the environment. We at Kemira are committed to being a leading water chemistry company. We will achieve this with our world-class cross-industry.
Okay, good afternoon. My name is Randy Owens, and I'm responsible for this oil and mining business within Kemira. We have, as Wolfgang alluded to earlier, we first began our operation in 2009. So I appreciate you being here, and my presentation is titled Profitable Growth. And so for the presentation, I want to relay to you really three key messages. The first, I want to give you insight into how we see the industry growing and how we see the industry developing. The second is I want to share with you how water is growing inside of the industry. So we see ourselves with two opportunities for growth, not only the industry, but also the water growth inside of the industry. And then the final is to share with you our strategy and how we aim to capture that growth that we see on a go-forward basis. For those of you who are not familiar with the segment, I'll let you read these items on your own in your booklet, but really there are three key points: who we are selling to, what we are selling them, and then why they buy from us. So let's start with the who we're selling to first. We are selling in the drilling, cementing, and stimulation space principally. So if you're familiar with the oil and gas value chain, there are really three distinct cuts to the value chain. The first, those that are reaching the oil. The second are those that are producing the oil. And then the final is those that are refining the oil and turning it into petro. So we are in the front end of that, the drilling, cementing, and stimulation space. It's a more dynamic space to be in. It tends to be more stable when you're in the areas of production and refining, but in the drilling and cementing space tends to be very active and very driven by the price of oil and also by the price of gas. And so in that space, we're selling to companies such as Halliburton, such as Schlumberger, as an example. And then on our mining business, our aim is to move into core metals. And those are very well-known companies like a Vale, companies like a Samarco. And then what we are selling to these two groups of customers is much like the other segments have presented to you earlier today. It is these process water chemicals. It is these chemicals that help them discharge their waste in a safe manner. It is these chemicals that allow them to then take that waste and repurpose it and use it into their production process. And so, and one of the reason that they buy from us is the key reason is yield improvement. If they can extract more oil, extract more gas, if they can take their reserves and increase their production of their ores, that's how they get paid, and they're willing to pay for that. They're willing to pay for that value. This is a picture of how we've been progressing with the business. We started in 2009. We've managed to move the EBIT from 6% to 13%. We've been able to generate organically 100 million euros of growth over that time period. And a lot of that is based on this strategy that we have, where we're really targeting this industry growth, we're targeting this water growth inside of the industry, and then we're able to price and also able to gain value for these applications that we're selling to these customers. This is our look at the world. We see 4 billion in growth by 2020. We start in 2011 with roughly a 9 billion euro accessible market. And as Wolfgang pointed out earlier, it's very important for you all to understand that the mature markets today and in the future will be a material piece of this business. And so from that standpoint, we're in a good position with our asset footprint. You know, our assets, our people, our competencies are in Europe and North America. But in the future, we have to begin to redeploy those assets and get them into APAC and into South America, so that then we can capture that growth that's going to come obviously as time marches on and as we move towards 2020. Okay, so that was the story with industry, and now I want to start off and speak to you about how we see water growing within our industry. Okay, and so the first piece of that is we see that produced water in the oil and gas industry will grow by 30%. And why is that? If you think for a moment in the North Sea, or if you think for a moment in China, for an example, as their production begins to decline, their first defense in order to boost that production is to begin to inject water into the formation. And they do that for a couple of reasons. It increases the pressure in the reservoir. It begins to sweep the oil to the producing wells. And so as these reserves degrade, more and more water is going to be consumed. And that's why it's a fast-growing space, not within the oil and gas arena. And then on the mining side, the mining industry doesn't have the luxury of being able to produce from the sea, where in the, like I said, in the Gulf of Mexico or the North Sea, they're able to take seawater and inject into the formation. The mining side is very much a freshwater story. It is on land, and it has been said many times that without water, without fresh water, you cannot have a mining business. And so mining in the not too distant past, they would open a mine where, say, 5% of the targeted ore that they were after, and another 95% would be gang ore or ore that they're not intending to use, and basically it's just a waste and it's something they have to manage. But as these reserves are now declining, their only opportunity to increase production is to begin to process more. So as they move into these degrading reserves, they begin to process more, and water is the key element for that processing. And that's why in this mining space, we see the growth of fresh water 20%. And so for the strategy piece, we try to be very, very straightforward with our strategy and play to the strengths of not only Kemira, but also within our segment. We started out by taking these core chemistries that we have within Kemira and then beginning to innovate around them. So our whole strategy is based on differentiation and innovation, and I'll say more about innovation in the next slide. But the real key is to have our application experts understand the industry, understand the problems of the industry, and then be able to take that back into our R&D community for us to invent, and then be able to take that invention and move it into our assets that Wolfgang spoke about earlier, and then begin to tailor that chemistry. So all three of these, not only the application, but the invention, but then also the production capabilities, is very key for us to execute our strategy. And I want to say something more about invention. You know, the way we see it is, it's nice to invent things, but it only becomes an innovation if you sell something. And so we spend quite a lot of time measuring how we're doing with invention. And so if we take a look at this second bullet here, when we say linking our customers' needs to our innovation process, we measure how we're doing with the vitality index. That means over a 5-year cycle, what percentages of our sales are coming from new inventions, and we are on track in meeting those targets. It's also very important to use this global network of R&D centers that we have. As we said earlier in the presentations today, we have centers in Europe, we have the Atlanta Research Center in North America, we have our research center in Sao Paulo, Brazil, and in Shanghai, China. And in our industry, it is very demanding, and time is of the essence. And so one of the key components of our innovation strategy is being able to invent and turn to innovation in a timely manner. And we do that by having this regional R&D centers. And as we've started out as a new segment, the final point that I'd like to relate to you is this becoming a recognized expert. And this is probably, it's a small statistic that's on the slide, and I know in the investment community you're more interested in sales growth than EBIT, but if you can imagine starting out in 2009 with a new segment in oil and gas and mining, Kemira not being known for oil and gas and mining, this year we will be up to 41 technical papers in engineering journals. And that's not a small achievement considering in 2009 it was 0. So this is one key metric, how we see that we're beginning to be recognized as an industry expert within the oil and mining space. So the closing slide I have for you, the 3 key components here: increasing water usage. That is definitely occurring within our industry as these reserves degrade, as they move into things like shale gas fracturing, as we move into enhanced oil recovery. All of those elements increase water usage. And then, of course, the long-term outlook for the industry is slated to grow. We said that the relevant market is growing from 9 billion to 12. And then the other part of that is the growth is occurring in mature markets and in emerging markets. And so from that standpoint, we're well positioned to capture the growth. And then the final, it's a 3-component, there are 3 key components to our strategy. The first is the applications, then being able to take it to invention, and then ultimately being able to tailor those chemistries and have a portfolio in order to service that application. And so as I close for you today, we've had a fairly successful run thus far. We like the position that we're in, and we feel that we're in a good position to capture the growth and the profitability in the coming years ahead. So thank you very much, and I'd be happy to entertain any of your questions.
All right. Any questions? Let's start here.
Hi. What are your key products in oil and gas, and how much do they represent of the EBIT? How concentrated is that?
Yeah, it's fairly diverse. Our key products are the polymer chemistries. We have, and that can either be for things like separation. It can be for preventing scale, and so polymers is a very broad category. So certainly there, and anytime you begin to help your customers with processing water, like for instance in the paper business, you have to be able to control bacteria. You have to be able to prevent water scale, and so many of these same chemistries that we have in our sister segments. We are also leveraging, and that's one of the key reasons we were really able to get a fast start with this business, is to leverage the technologies and these core chemistries across Kemira. And those products are listed on that first page there that show the key chemistries for us.
Would you be able to split out the revenues for you that go into sort of new wells or new areas where there's drilling or development, and which one is sort of recurrent, where you have a mine or a well continuously need your products and therefore it's recurrent revenues? Yeah.
Well, the reoccurrence, even though we're in this drilling and cementing stimulation space, the reoccurrence happens when our in-use customers lock into technologies, and then as they are drilling in a field, they stay with that technology. So for instance, in the shale gas spaces in North America, they would lock into a package based on a number of changing variables. So it's a little bit of a difficult question. I hope I don't go too deeply with it, but for instance, the salt water changes, meaning the amount of produced water that's coming back from the fracking job, the amount of water that they're getting from municipalities or a river, the depths, the temperatures they have to go through. And so it's really a tailoring that happens with our applications people on site and or with our customers, depending on the job that they're doing at the time.
So what would be 60% of your revenues of that division would be sort of recurrent business, or 80? Or?
If I had to venture, venture to guess on a reoccurrence factor, we would be above between 70 and 80% from a reoccurrence.
Thank you. And then looking at your operating margin development over the past 3 years, you say now 20% of your revenues is coming from new products. That margin expansion, how much has that been reducing the cost, being able to raise prices, or because of the new products? How sustainable is that?
Could you say it? Could you come one more time with that?
So the margin over the past, on one of your slides, first slide is the margin going from, or is it 6% to 13% operating EBIT margin? How can you split that development in margin, being able to price, being able to raise prices and keep the cost there, or is it to reduce the cost? Or is it because of the new products that you've launched, that you have 10% new products and now you're 20%, so therefore that's...
Yeah. It is, it has been a heavy balance on pricing and moving away from product sales, and that would be the largest portion of it. And then followed by innovation. In bringing and tailoring and bringing new products to that space. But the majority of it would be pricing the value of the applications.
Marko Rovinen, Evli. I believe Fit for Growth for you means savings of 12 million. Could you talk a bit about that?
Yeah. Well, we of course as a segment are using the functions inside of Kemira, and so as adjustments are made and as we simplify our organization, elements of that trickle down to us, and so that's the largest piece of that from our standpoint.
So, administration, or what do you?
It would be functional cost. Functional cost.
Maybe last question. Because mining and oil and gas markets have done very well recently in the past few years, how sensitive are you to volumes with your operational margin? So if volumes would go -10, what margins would you then be achieving?
Yeah. Well, we have, as you know, we've had some very strong wins in our face this year. I think if you look at the metal indexes in the last 12 months, most on an average, the volumes or the pricing is down 20%, and then in North America, for instance, shale gas pricing or gas pricing has dropped from the 4s into 92. So far, this headwind, we've been able to grow over that by our new applications and our new inventions and growing market share. And so, as you see, our revenue being relatively flat this year, we've been able to overcome that softness in volume. So the sensitivity, of course, is there, but if we keep, practicing this strategy, focusing on this water growth inside of the industry, we believe we can take out some of that cyclicality.
Okay, maybe one question.
Just a quick follow-up question to that. Can you mention a couple of those new innovations that you have brought to the market?
Yes, absolutely I can. For instance, in this shale gas space, where now we are drilling horizontal laterals up to 2 miles now. All along that process, they're what they call legs, where they drill a certain distance, they fracture with high pressure, that water is returned to the surface, and they continue that process for 30 legs now, reaching up to 2 miles. Well, one innovation area is they are after efficiency and energy reduction in that process. And what we were able to do is take our polymer chemistry, which helps them with efficiency and energy reduction, but then also patent that and connect it with a biocide or a preservative, so that then we can help them preserve the integrity of their gas production by not having microbiocides or microbial activity and contaminating the reservoir. So that's an example of where others would look at that as two single applications, but we were able to combine that and patent it and then ultimately be able to charge higher prices for that invention.
Thank you.
And there's also some examples in the back of the appendix. If there's, I think there's another one on mining that would give you a good indication of that.
Okay. Yes, that's true.
Okay.
Thank you very much.
Okay. I think we have our next speaker, Frank Wegener, who's the president and responsible for our ChemSolutions business. So, Frank.
Thanks, Randy.
Yeah.
So, good afternoon, everybody. I'm very happy to be here. This is my first time in the Capital Market Days, and I'm also very happy to present ChemSolutions to you. I would like to answer to two big questions from my perspective, big question today. First of all, what is behind ChemSolutions, because it has been basically as a segment not really visible for you. Second of all, I would like to answer to the question what value maximization means. But to start with, in order to make you familiar with the ChemSolutions business, I would like to show you a small video, a short video, which highlights the main markets and the main application of ChemSolutions.
Landing safely and responsibly, ensuring food safety, helping people to keep healthy and contributing to people's health, providing sustainability in the food chain, and adding comfort and safety at times when we need it. These are the important matters in our daily lives. They call for good and safe solutions. Solutions that the products of ChemSolutions provide. Kemira is a global chemical group leading in water-intensive industries. At various sites across the globe, Kemira works on innovative chemical solutions for its customers and consumers. Products are developed and tested at research and development centers all over the world. Our state-of-the-art production facilities are located in Finland and the Netherlands. Here we produce organic acids, their salts, blends and derivatives. Products that are being used in food, feed, chemical and pharma industries, including runway de-icing for airports. Animal feeding is the foundation of human food. Safe feed, free of mold and bacteria, ensures healthy animals and improves animal performance. The growing world population and stricter safety regulations requires safe food, which needs to have an extensive shelf life. To comply with all of these requirements, safe solutions are needed, solutions that Kemira is continuously working on. We also supply active pharmaceutical ingredients, excipients, and pharma-grade raw materials. Our pharmaceutical products are used in various ways for the treatment of diabetes, as raw materials in dialysis and infusion liquids, and in the manufacturing of antibiotics, enzymes, and vitamins. For example, our calcium acetate is used in the treatment of hyperphosphatemia. Apart from the pharmaceutical industry, also tanneries benefit from ChemSolutions expertise. We are a global player in the chemical and rubber industry. Our formates and acetates are used in chemical applications around the world. For example, formic acid is used in the coagulation of natural rubber latex. This ensures that high-quality products, such as surgical gloves, can be made. Formic acid is also useful as a biodegradable component in household cleaners. In aviation, we are also a main player in airport runway de-icers. Our products are sound solutions for the environment and at the same time ensure safe takeoffs and landings. Safe and responsible solutions worldwide. That is our continuous mission.
So you have seen quite a variety of different applications. Just worthwhile to mention, in all the applications mentioned here, we have a leading position. I'd like to mention some of them you have seen in the video. We are active in the pharmaceutical industry. We are active for our customers in diabetes treatment. So our customers which are actually busy with diabetes medication, they appreciate our high quality acetate, pharma acetate, and these pharma acetate are very important for them. So diabetes is growing, unfortunately, with 9 to 10% per annum throughout the world, basically due to unfavorable lifestyle changes everywhere in the world. So a nicely growing application, and this is of course reflected in our business. In the feed business, we have a leading position, especially when it comes to state-of-the-art application of organic acids. Organic acids are used in animal performance. They are used also in feed preservation, and especially in animal performance enhancement. They can replace, at least to a major extent, the antibiotics, which are still used to a major extent, and which are due to adverse effects on the human bodies coming under threat in almost all geographies. In Europe, they are already banned since 2006. And the last business you have seen in the video, our airport de-icing, airport runway de-icing business, the smallest business we have. For us, it's a European business. It's also based on the same type of chemicals we are using in other customer segments. Europe as a market is relatively flat because the air traffic in Europe basically not increasing heavily anymore. There the growth is basically taking care in emerging markets, and especially in Asia Pacific, where the air traffic is growing. The key question is, why are customers buying from us? What do they appreciate with Kemira? What do they appreciate with ChemSolutions? And to start with, if you look at this slide here, the bulk of our customers is buying products from us, products where the people appreciate, where our customers appreciate the positive, the favorable relationship between price and benefits. Our customers appreciate our products in terms of their quality. They appreciate us in terms of reliability. Just to mention one example here, pharma customers, they need reliable supplier. They need good standards. They need products which are complying with all regulations, and that's what we are doing. Only the minor part of our customers, they are requiring service. For example, customers in meat preservation, they require quite intensive service because this is a demanding industry where, different formulations are applied to different challenges the customers have. The reason why I'm showing this slide is to really point out that cost competitiveness in our operation in ChemSolutions is crucial to be competitive on the market. We have one product group, and that's formic acid, and Wolfgang has mentioned that in his presentation. Formic acid is our product group where we are backwards integrated with a plant, with a state-of-the-art plant in Finland, and that's really where you can see where we have our strong competitive edge, in front of our customers. So, answering the question how Fit for Growth will bring us to the E10, which is the group target for Kemira. Before I do that, a few words on what has happened in the past few years. You will ask that question anyway. How does that graph look like that? So In some of our product lines, we have been faced with a situation that the playground has been changing. And to come up with one example here, Randy has mentioned the shale gas situation in North America. And this situation that shale gas is widely available cheaply in North America has actually favored some of our competitors, especially those competitors who are producing chemicals where we are not backwards integrated. So some of our product lines have lost part of the competitive edge, and that's one of the reasons why, in some parts of our business, we are not showing the performance we have historically shown. How do we cure that? So the management is committed to come to improve the performance to an EBIT level of above 10% by 2014 by focusing on core product line. And this basically means, in our case, formic acid and derivatives will be our core focus. We will also focus, of course, on the associated technologies. The other element which is important to come to E10 and above is significant reduction of complexity in our operations. Significant reduction of complexity. A good example for that is we have already decided to reduce the number of stock keeping units by 80% in our most important product line. So this complexity reduction will actually lead us to a situation which is easier to manage, and also it will enable us to reduce cost significantly. Last but not least, what Randy mentioned also, there is the Fit for Growth program continuing in Kemira Group, and the functional organization is reducing or is increasing efficiency by reducing complexity as well. Last but not least, ChemSolutions will also benefit from that. All in all, and Jyrki will come to that later, we are talking about cost savings in ChemSolutions of about 4 million euros. And this, together with the measures we are taking from segment point of view, we are confident that we will achieve the performance increases which we are targeting. Thank you very much for your attention. If there are questions, I'm happy to answer them.
All right. Is there any questions? Here, the back.
Thomas Hoda from mine. First, sorry if I've missed that, but the key raw materials you have mentioned that were limiting your competitive edge. Could you name just 2 or 3?
Yeah, we are basically working with formates, with formic acid and derivatives and their salts, with acetates, salts of acetic acid, and propionates, the salts of propionic acid. And especially if you look at the competitive situation of manufacturers of propionate and propionic acid, you come to the conclusion that those producers who produce in North America have a competitive advantage due to the availability of cheap or low-priced shale gas. And that's what was happening. So since we are producing in Europe, we couldn't enjoy that benefit of the shale gas, advantage, which some of our main competitors in North America have.
Right, and a quick follow-up on another question. The synergies you get from being within Kemira, how would you describe this?
Well, I mean, the setup in Kemira is so that we have a segment organization which is very lean in the case of ChemSolutions, and we have a functional organization taking care of supply chain management, taking care of HR and other functional arenas. So ChemSolutions as a fourth segment as of 1st of October is part, as before, but now visible, is part of that functional or takes benefit of the functional organization of Kemira. So in the same way as Randy, as he pointed out before, is benefiting from increased efficiency and reduce cost in the functional organization, ChemSolutions is doing the same.
Hannu, Danske Markets. About this complexity reduction, how many products and customers do you approximately have? Just to get an idea of how much of this customer and product rationalization is coming from ChemSolutions. Thanks.
Well, I don't want to comment too much on customers, but if you just focus on products, we are having several hundred. I mean, you have seen Wolfgang Büchele's number of more than 5,000 SKUs. And if you look at ChemSolutions is 10% of Kemira's turnover, and this is roughly the number of SKUs we have in our segment as well. We have seen, I mean, the 80-20 rule is here applying as well, that by reducing the number of SKUs in our main product line by 80%, you do not cut your revenues heftily. But what you can do is you can use the product which is then available for other applications, for other customers, for other products. You can use them either to migrate or to move to other regions with that, for example. I mean, with other words, by reducing the complexity drastically, you do not only reduce your cost, you also create an opportunity to move, for example, to more valuable products.
Looking at your contribution in revenues as a total of the group, it's sort of 10%. How important is your division from a scale point of view? If you could double the revenues, would you be easily at 10% back again? Or how much is the scale for you? How important is that? Production scale and distribution scale.
Well, I mean, you need to distinguish between our core product lines and the rest we have in our segment. In the core product line, being formic acid and derivatives, we have a state-of-the-art facility. We are the number 2 in the world. BASF is more than double the size as we are, so we have a state-of-the-art facility. If you would double that production facility, for example, you would create an oversupply situation. So, I mean, doing that in Europe is anyway not an issue, and doing that somewhere else is creating, at least if you do it with the same size, it would create an oversupply situation.
How easily do your products travel around the world? So if you would produce in Europe and sell it in Asia, or do you need to build facilities in Asia or somewhere else?
I would like to answer in the following way. We have one production facility in Finland, and we export quite profitably to basically all regions in the world. So these products, formic acid and derivatives, travel quite well. The same is accounting for our production facility for propionates and acetate in the Netherlands. Also from there, we export into all parts of the world. So from value point of view, we are talking about products which are around €1 per kilo. So they typically travel rather well.
Okay. Thank you very much.
Thank you very much,
Frank. And before we continue to the third set of presentation, I suggest we take just a short 10-minute break and then continue.
Okay. Welcome back, ladies and gentlemen. And I would like to present to you the very interesting part of the world, which is the most fast-growing and also a lot of opportunities for us, for Kemira as a whole. And there are two key messages which I would like to present to you today. One is, what are the big potentials? Where are the potentials which are of interest to Kemira? Second is, how are we going to capture this fast-growing market which are of interest to us? These are the two key messages which I'm going to present to you. First, let's have a look at the upper part there. As you can see here, our sales here of year to date is only 6% of our total Kemira sales, which is a very small part of our total global sales there. Whereas when we look at the potential of the water chemical markets in the year 2015, there you can see there the APAC region, there's a potential of 37%, which is very big, which means there's a big potential and ample room of growth opportunities for us here in this part. Now let's have a look at the lower part of the chart here. You can see that in the year 2011 here, that the total accessible market to us is 6.1 billion euro there. And according to our analysis, we have segmented it into a way which is following our Kemira portfolio there. And as you can see here in the year 2020 there, we have a very big growth rate here compared with the rest of the world. We have the highest growth rate in the region, which is 5.2% there. And you can see here, in the year 2020, we will be reaching around 10 billion euro there. And the biggest growing part here is in the paper and also in the mining and the oil and gas there. These are the most interesting part for us. Have a quick look also at our operation in Asia Pacific region here. I'm based in Shanghai, and I've been there based for 15 years already. And I must say, I can see the market is really growing very dynamically in the past 15 years, the time when I was there. And our head office for the Asia Pacific region is also in Shanghai there. In the APAC region, we have got 4 production facilities, as you can see in the red line. There are 3 major ones. The one in Singapore is a very small one, but we have got 3 major ones. One is in a place called Yenzhou, which is producing the AKD, and then we have the Nanjing one, which you have heard a few times already earlier, that is coming up very soon. As of first quarter of next year, we will start the production there. And then we have another one coming in also in India. There we are producing, and then it will be starting operation also in the in the 4th quarter this year. So it's coming up very soon. And in the APAC region here, you appreciate that there's so many different cultures in there, and also different language, and also different interests of the business for us here. So in APAC here, we sort of, sort ourselves out which are the most interesting part for our business to grow. So we chose to grow into this market there of which business segments which is most beneficial to us. In China, we said all segments there. Whereas in Indonesia, it's mainly paper and mining, which is the most interesting part for us there. And in India, it's the M&I, which Hannu has presented earlier, and then with paper. So these are the growing segments which are of interest to us in these 3 most important markets in APAC. These are the production facilities in APAC region here. As mentioned earlier, we have got this Yenzhou plant, which we have started operation as of Q4 in 2009 there. AKD is a kind of sizing product for paper. And this is one of the very important firm stepping stone of Kemira entering into the market there, which really gives us a very big footprint in the paper industry there to assure the market that, hey, we are coming. We are serious about this market here. And this is a very big footprint in this industry. And this plant is producing AKD wax, which is now the biggest in the world. The AKD wax is the biggest in the world. Second one, in Asia Pacific region here, we have got the Indian coagulant plant, which is coming up very soon. It will be next month that this plant will start operation as of, and here is the Indian plant, which we will be making coagulants there, and it's a 51% joint venture of Kemira. This one, we have an early bird or first mover advantage in this area here. Whereas in the sizing here, when we have this Nanjing production plant coming up there, which we are producing the ASA product here, this is another sizing product which Kemira is very strong at, and is giving us a very strong leading position in Asia Pacific, in the whole of the sizing market in the Asia Pacific region there. So here, this is the Nanjing plant, and here's the India plant there. Now let's have a quick look also at the this growing market also. As you can see here on this left-hand side, or from your side there, you can see that this expanding this global middle class here in the whole world. You can see this big growth here. This is, you can see here, this is today, and the middle class number is 1.8 billion globally. Whereas in 2020 here, you can see that it's also jumping up. So with this big growth here, what you can see is also that 85% of this growth is coming from the Asia Pacific region, which represents a lot here, which means they will be demanding better living standard, better clean water, and also the demand for the paper also, which in the case here would be, say, for example, the packaging and board, and also tissue. Say, for example, in the family there, nowadays, we are using less and less handkerchief, and we are using more tissue paper. And also the per capita consumption is very low still in APAC there, which offers a big opportunity also for us to grow there. On the right-hand side here, you can see this relationship between the GDP growth and also the CPI percentage for the next 5 years there. And as you can see here, you can have three bubbles. China now, which is now the second biggest economy after USA, is representing a GDP growth percentage of around 8% there. And you can see India, Indonesia, both are here on this side, which means they are all growing nicely, at least in the next 5 years, according to the World Bank prediction here. So here, you can see that Japan is up here with a very slow growth and also with a high CPI there. So whereas our focus market is really here, this is where we have focused so far. And we focus these markets with a very good reason. China, which is the biggest within the APAC region here, of course, we said China. But even within China, we realize that it's not a unified market. It's a unified country, but it's not a unified market here. And you can see that we have this so-called East region, and if you look at the East region here, the GDP compared with the rest of the country is actually 3 or 4 times higher. So of course, when we look at the GDP per capita of China, it gives you a figure. But of course, the GDP along this coast here would also be significantly higher than the rest of China or the GDP per capita of the whole country. So here you can see here, of course, they have the different regions, but of course, what is important for us is in this East region here, where we have our plant and production and also our focus of our sales force based along this line here. The other thing which we should also perhaps to look at is that when you talk about China, we always would not be easy to avoid talking about this so-called 5-year plan. And in China, they always come up this 5-year plan. This period of time from 2011 to 2015 is what they call the 12th 5-year plan. And in this 12th 5-year plan period there, they clearly say that the economic growth here is 7% or higher than 7%, which in most cases would be 7 and 8% between this range here. And also the CPI would be under control of around 4% or even lower. That would be what the government is aiming at. And I've been working with the China market for more than 20 years. And what I have seen is that, in the past, so-called this 5-year plan, they always are able to deliver what the government wants. And this is something which is very good for China, so it's always predictable in a certain case there. The other thing which I would like to share with you is the urbanization here. As you can see here, the urbanization now, which the Chinese government is also now pushing very hard, is that here the urbanization rate is 47.5%, but then it will be jumping up to 51.5% in the year 2015 here. So with this big jump here, the urbanization rate here, which would demand a lot of the wastewater treatment there. Because in China, a small city, a small town, say for example, Wuxi, they have 5 million people, which is the same size as Finland already. And of course, Shanghai is a much bigger city there. And of course, when you talk about mega cities there, they have quite a lot of mega cities in China. And there, when you talk about, say for example, the wastewater treatment plant, which we are working with, they have a wastewater volume of about 2 million tons a day, which is huge. And this kind of mega city wastewater treatment plants is not everywhere. So we have big opportunities there. The fossil energy here, we have now also, this is going to have more energy, and they are going to build more power plants in China because of this, what I mentioned earlier, the economic growth and also the middle class requirement, etc. So the power plant, the building of the new power plant also offer us a lot of opportunities. Also, especially in the industrial water, for example, there. Because we do have our antiscalant, corrosion inhibitors, defoamers, biocides. For example, we have one customer in Indonesia. They are using the water as seawater as a coolant in the cooling tower there for their power plant. And they have faced a lot of problems there. Because of all the seaweeds and all these little animals from the sea there. So our biocides has helped them a lot, and also this corrosion inhibitors there. So those give us a lot of opportunities there in this new emerging market there. And also this, the last point, but not least, is this water consumption. Chinese government also declared that they would like to reduce the carbon dioxide emission, the energy usage, and also the water consumption there. So the reduction in consumption of the water actually gives us an opportunity in our WQQM. By now, I'm sure you will be very familiar with the WQQM already. So with this quality and quantity management here, actually gives us a very good opportunity because, like say, for example, in the paper mill. Paper mill, a huge part of the paper production is using water. Now, we help them to use less water or reuse the water there during the production process there. And this is very helpful, and the customers do appreciate that. So we are not there just to sell the product, just to sell the chemical. We are there also to offer our application know-how, which the customer appreciate there in the market. So our key focus in the medium term for us is the sludge treatment. Here we are talking about the dewatering, the sludge dewatering. As I mentioned earlier on, with this urbanization there, they are going to have a lot of this wastewater treatment plant in China, and also in India. Also, these are coming up. Now, with this dewatering there, we have a know-how advantage also in the sludge dewatering. The government in China is asking now for 80% of the water content. And now, because of all sorts of problems and landfill and the others, they are now asking to reduce this water content of the sludge from 80% to 60%, which is not everybody can do that. And we are in a very advantageous situation that we can offer this kind of know-how to the customer and the government do appreciate this. Because now the sludge, they are not using it for the landfill, they are using this sludge into their, how do you call it, this incinerators there, which in somehow also can produce energy there. So that helps them a lot there. The other thing which I've mentioned earlier is this industrial water there, and the wastewater treatment, which I've mentioned earlier. There we will also put more emphasis into this power plant, especially there. And also in the coal plant, in the coal mining business there. Because they're still using a lot of coal there. And the coal washing, for example, we have also business in that area there. Shale gas. Shale gas is one area which China has claimed to be having a very high shale gas reserve. I think America, China, and I can't remember the third one there. They have the highest, sorry? Argentina, yeah. They have the highest shale gas reserve in the world. And they also give us a very big advantage because we have got a lot of know-how from North America, which can then apply it into China, because those customers are mainly the big guys there, the Halliburton and the others. So there we can use those connections and then bring it into our part of the world there. R&D center, we have already seen this slide a few times already, I think, and I'm not going to repeat more. But what I would like to draw your attention to is the 2 points here. The sludge dewatering and the membrane technology, which the R&D center in Shanghai, we are giving these 2 lead projects there, because in our part of the world there, these are the most important projects for us, which we can also take the lead and also share this kind of technology with the rest of the world. Because say, for example, this membrane technology, and then I think Hannu mentioned about this earlier, that actually in Asia there, most of them, they have this new plant, which are not using some of the technologies which are rather matured in the West. So they're jumping into a new technology there, which also gives us actually an advantage to bring this new technology into the region there. Last slide, but not least, and here we have got this, as I mentioned earlier, a very strong position in sizing. Now with the AKD and with the ASA here, that gives us a very strong position in the sizing in the whole of the Asia-Pacific region there. And also in India, we have this very successful desalination, and this desalination is going on there, and the drinking water part, and it's not just India, but of course also in the Middle East also. These are the important regions also for us. And also I mentioned already this, not going to repeat here, the sludge treatment and also this industrial water and the shale gas. These are all the important growing areas for us here. And the last year, you can see that we have also a significant growth in the year 2009, because there we have acquired this AKD plants and started production there as of 2009 there. So there we have a big jump. And there, early next year, we will have our Nanjing plant coming on board. And very soon, we will also have another wave also for our growth in the region there. So that ends my presentation, and I would be very happy to take any questions if you have.
Artem Beletsky, SEB. APAC was 6% of Kemira sales year to date. How much of sales what you are generating in APAC is actually chemicals which are produced locally?
At the moment, we have about now half, a little bit less than half of that is being produced locally. Yep.
And what comes to this investments coming upstream in India, in China, how much those will be boosting, let's say, your chemical capacity in the region? Because it is likely to be filtered or will be seen presumably quite rapidly also in sales growth.
You are talking of just the capacity there, yeah?
Yep.
Okay. Well, the Yangzhou plant is already running full capacity already, and because it's operating already for 3 years already since now. The Nanjing plant will only start production as of Q1 next year, which would also maybe, according to our projection, it would take about 2 years to run into this, not full capacity, by then probably around 85% there. That would be in our projection there. And the India plant there, which will be starting as of October there, and there, as I said, we have a first mover advantage there. And there, I can't remember exactly the figure there. There, I would say, because it was about 2 to 3 years also in order to ramp up to this significant capacity level there in APAC, in India, I mean, yeah.
And when this capacity is up and running at full speed, what kind of if you don't assume any additional exports, what kind of revenue levels you would be expecting to generate in APAC?
Well, we have, of course, the first thing, of course, the reason why we built a plant there is not just to take advantage of the cheap labor, or because, in the chemical industry there, that's not relevant. But really, it's our intimacy and closeness to the customer, to the market there. And that's the most important part there. Now, your question is, how much more revenue we'll be generating there with all these plants up and running. The first one, Yangzhou, is already up and running already. The next 2 plants would be $20 to $30 million, yeah. In the next few years, it'll be coming up, yeah. And of course, it's not ending here. We have also new products going to introduce also into the plant there, yeah.
Right. Thank you.
Markku Järvi, Evli. Could you just highlight the new organization you will have in Asia and how that will change the way you operate?
Yeah. Okay. Thank you for the question. Yeah. And as Wolfgang mentioned earlier, now it's more of this regional business unit operation. And then, with this operation there, we will be making quicker decisions to the market there. So we'll have got all these segments there. We'll have an RBU, or what we call the RBM, where they do not have the manufacturing units there in the APAC region there. But then most of this will be having this directed autonomy, will be empowered to do, as instructed and agreed by the management board there. And those are the very important decisions. Because, so far in the past, it was always rather centralized in Helsinki there. But nowadays, the market is now, or the region is now given the empowerment and autonomy to do these things and decisions, and those will be quicker. Of course, there's a framework of, margin requirement, etc., and also an agreement of, which kind of products to enter into which market there. But then, overall speaking, it's I would say, it's a good thing that this is moving into this direction there, because the world is now changing much faster. So we have to also to move at least the same pace as the world is doing.
Would you say that you'll be making more decisions on regional basis than on segment basis, or how's the does that change now, or?
Well, of course, we are not just making decision blind. Of course, we are making decision based on the global requirement by the segment there, and of course we have to agree on something, and within that framework there, we can make quicker decisions there. That would be the idea. Yep.
Hannu, Danske Markets. What do you think is the biggest challenge for you when you try to achieve your growth targets? Is it finding the right people, product development, competition, or something else? Thanks.
Yeah. Finding the right people, of course, this is always not easy for everyone. And also the thing which we are doing now, of course, we are also expanding in the region there. Of course, to find the right people, that's always important there. And also, I forgot to mention about this R&D, and thank you for asking that. That in R&D there, one of the major part of that job there is also to do the local adaptation, customized products which are suiting the market need there. So it's more of the smaller R but a bigger D in that part there. And this is serving the purpose of the market, and also the idea of having this in Shanghai there to serve the whole APAC region there. And we are also building up our application team there in the region, in, say, for example, in Shanghai and also in Indonesia and in India, building up this organized application team which can serve the market better by not just selling the product at a price and compete on the price there. So the application service with our experts, and that's very important there.
Thanks. Just another question on competition. So which one worries you more, the emergence of local players or the big Western players entering the market? Thanks.
Of course, it's different playgrounds, I would say. With the local players there, most of the time, they do not observe the EHS issues there. And they sometimes compete on the more advantageous situation, in the short term there. So, in certain area, they might have advantage there. But most of our customers there, like the paper business, for example, these are the big paper mills, and they could not afford to buy a lower, cheaper local product, and then, at the expense of, the billions of dollars of this paper running machine and then stop for an hour. It will cost them a lot more. So most of our customers, actually, they are buying products from us because they feel much more confident as a reliable supplier, and which we are going to also to be in this business for long term. So those are the customers which we are targeting at there.
Thank you very much.
Yep. Thank you.
If we have to take the next.
Sure. So, ladies and gentlemen, I hope your energy level is still high. My name is Hilton Casas. I am the regional head for Kemira in South America. I'm based in São Paulo, Brazil. Likewise, China, South America is a very interesting growing region for Kemira. And during my 10-15 minutes presentation, I would like to give you two messages. All segments where Kemira is present are growing faster than global average. And my second message is to say that Kemira is already very well established in South America, and we are ready to capture this growth. Let me start by the later statement. So we are relatively new in South America. We have established our operations in 1996. And today we are generating about 8% of group turnover. Kemira invested substantial amount of money already in the region, about 108 million euros, to show the commitment of Kemira with the growth in the region. In terms of sales office, we are present in 5 different countries. With this setup, we are covering more than 80% of the region GDP. We are in Colombia, and from there, we are covering all the Andean region. We are in Chile, Argentina, Uruguay, and Brazil. We do also have manufacturing facilities. We have 3 production facilities for paper. In Uruguay, perhaps the most relevant chemical island in the world. From there, we are supplying customers in Uruguay, Argentina, and Brazil. We have also a paper chemical manufacturing in Brazil and supply all Brazilian customers from there, but also Argentina, Paraguay, Chile, and Uruguay. In Argentina, we are only operating 1 dedicated production to an important customer there. From municipality point of view, we have 4 manufacturing sites. They are all located in the most relevant part of Brazil, where we are supplying coagulants to the municipalities, but also for paper and for oil mining. And last but not least, we recently opened our R&D center in São Paulo, and I will come to this point later on. I said that South America is an interesting region for growth. Let me try to give you rationales. I'm sure that you are very familiar because you are coming from the financial segment and you know the figures perhaps better than I. But just to show you that South America is a region of $4.7 trillion of GDP using the purchasing power parity methodology, Brazil being about 50% of this total, and the Andean countries, they represent roughly $1.3 trillion, followed by Argentina. So in terms of GDP, we are about 40% of China, 20-25% of European Union or North America. So it's already a relevant market, South America. But the good news for us is related to the growth. As already mentioned here, many countries are growing in the rate of 4 to 6%. If you see the average expected for future, for the years to come, is roughly close to 6% in South America. So Brazil with 4%, Andean region close to 4%, countries like Chile, Uruguay, Paraguay growing above this value. Another important element for us is related to the inflation. So you see that still some concerns in Argentina and Venezuela, but all other countries, inflation is relatively under control, and so the interbank interest rates. So this is giving more power to the industry to invest in the region. As a consequence, all the international risk agencies, they are gradually improving the situation for Brazil. So they are saying, from the region, sorry, they are saying, go there and invest there. So a stable economy is already present in the region. Coming to the point of the segments where we are present in the region, I would like to start with paper. If China is a region for paper growth, South America is a region for growth of pulp production. Although in paper we are also growing nicely, we are following the local GDP. So expectation of paper growth is about 4 to 5%. But for pulp, it's much bigger because we are producing pulp to export mainly to Asia. And the reason why South America is growing faster in pulp is very easy. So we are very cost efficient in short fiber eucalyptus pulp. So South America has developed a very high technology in forestry of eucalyptus. So climate is helping. And then you can see from this chart here, the total land needed to produce 1 million tons of pulp, short fiber, in South America compared to other regions. So in South America, it's needed 100,000 hectares, and in Nordic countries, 7 times more. Iberia region, 3 times more. So this shows very clearly why the region is so competitive in pulp. So there are many investments already in place in new pulp facilities. So all customers of Kemira, or important customers of Kemira, they are really interested in this opportunity. We have many investments. We're expecting 7 million tons of new capacities to come on stream by 2014. Local big companies, also international companies, they are investing there. And there are expectations for more 3 million tons to come by 2020. So each of these investments, if you are familiar, they are ranging from $2.5 billion to $3.5 billion. Very, very important. So in total, we have today already about $12 million investments in Brazil and Uruguay. And what is important to mention, they are all Kemira customers. We are already supplying to this segment there. Other important growing segment for Kemira in South America, oil mining. In oil, in Brazil, new reserves have been discovered. And the state-owned company in Brazil, Petrobras, they are producing today about 2 million barrels of oil per day. And the expectation is that by 2020, they will be doubling this production, close to 4 million barrels per day. Also in mining, there are huge investments coming to the region. Expect by 2020, $108 billion investment in different countries for different type of minerals there. What is important to mention here, that all this new production will require innovative products. It's not only simply transferring the existing technology, but adapting our technology to meet the local requirements. So that's very important. And we have this possibility. And I would like to mention also Argentina. Even with all these political issues today in Argentina, they recently discovered the third most important shale gas reserve there, and they have to produce. They need to capture this benefit, and this will be also a very interesting, very important segment for Kemira. Another point, another element important to mention here is regarding environment. So the legislation getting tighter and tighter, so they also need to take care of the environment. There is a lot of concerns regarding supply, handling, and reuse of water. So then again, innovation will play a very important role in this segment. Another important area for us is municipalities. I like very much this chart here, because this chart shows, is comparing the infrastructure in Brazil to all countries, or many countries, and all countries that are above this red line, they have a much better infrastructure than Brazil. So in average, if we compare to the road, only in electricity, Brazil has a relatively good infrastructure. Is this a problem? This opportunity. Because there are many pressure. So the government, they know they need to catch up. They need to improve infrastructure there. Pressure coming from the society, pressure coming from the legislation. Brazil will be hosting 2 important events in future, FIFA World Cup, Olympics. So they need to invest in infrastructure. So there are many investments already coming to improve infrastructure, especially in wastewater treatment. I would like to give you a very interesting example in this area of municipality where Kemira is improving the overall quality of water in São Paulo. So this is a case of our lake restoration. There is even for me, quite difficult to pronounce, Taiaçupeba is a drink water reservoir located in the metropolitan area of São Paulo. So this reservoir is responsible for supplying 3 million people drink water. For many years, the municipality is suffering with the formation of algae because of overnutrition of phosphorus there. So they have tried many different technologies like copper and sulfate, hydrogen peroxide, and they failed. So since April this year, Kemira started a cooperation with the municipality with a different technology based on aluminum coagulants, but not only supplying the products, but taking care of the application. So we have boats on the lakes, so we are monitoring and dosing the products there, and the initial results are very, very promising. So we have already other 2 lakes where we are applying this same technology, and we are convinced that this technology will be approved by the municipalities, and then we have opportunity to roll out this technology, to introduce this technology in many other lakes in Brazil. So this is one very remarkable example where our technology is really helping the municipality to solve issues in the region. It's very important to mention, like my colleague in Asia said, we also have our R&D center there. And Wolfgang already said is more the D part because we are adapting the existing technology to meet the local requirements. But we are also developing global expertise, especially in areas where Brazil is leading this technology, like bioethanol, biomass utilization, and especially mining. As I show you, mining is growing very fast and will become a very important segment for Kemira in future. My last slide is to show that we have been growing fast during this period that we are present in these 50 years of presence in South America. So we showed already this capability to grow fast. We see many investments coming in future that will boost our growth there, and we are ready to grow. So thank you very much. Any questions you may have, I'll be more than glad to answer.
Is there any? Yeah.
Yes.
On your first slide, you mentioned over the past 15 years, Kemira has invested 180 million euros, and revenues today are 162 million euros. Can you maybe highlight the 180 million euros? Do you know where that is? Is that plants? Is it R&D? And because that would mean, from a point of view, that the returns on the investments are not that great.
In total, if we see from the beginning, we invested in greenfield investments in paper production or paper chemicals production. The most relevant investment was in Uruguay with this chemical island I mentioned to you, perhaps the most relevant chemical island today in the world. In paper chemicals in Brazil, and in this small manufacturing facility in Argentina. Those were greenfield investments. In coagulants, M&A, we acquired companies there. So, and then other minor investment. We are right now expanding capacity in Uruguay to take this opportunity in pulp. In terms of return, these investments, they are giving the return, especially the greenfields, they are giving the return expected by the company.
Could you give a feel for the existing investments that you have? How much can you grow your revenues, because it's a fast-growing area, without spending a one-for-one? So $1 investment will give you $1 of revenues. So the capital turn, how?
With existing investments, we have in our target to grow 7% in average. And I think we can grow. It's not only with the existing investments, but we are also selling important products there. We have products that we can sell in the region, and we have important sales of imported products in the region. But of course, if we want to capture, especially, and Petri already mentioned this, the future growth in pulp, we need to invest there. Is that a fair answer?
think we go on bits.
Then let me invite Jyrki Mäki-Kala, our CFO.
Okay, ladies and gentlemen, it's great to see a room full of people who are interested in Kemira and Kemira's future. So I have been the CFO in Kemira for 16 quarters, not years. And during the next 20 minutes, I will go through some of the financial items and maybe especially focusing on the Fit for Growth program. Creating shareholder value, that's one of the most important things for a company. And we, as a management team, have defined 3 major items on that road. First is the earnings potential. First is the growth opportunities. And then the third one is that we have a strong balance sheet. If you look first at earnings potential, we will discuss a little bit more about the Fit for Growth program and what it really means. You have heard the stories now about the new organization, what it means in the regions, and how it will foster the growth, also in the high-margin businesses, like oil and gas as an example. And then cash flow management. Right balance between investments, dividends, cash flow, it's very important going forward. We need to grow. And the organic growth going forward, we have excellent position in the mature markets, further strengthening that position. But we have seen and witnessed the growth in our portfolio, like in Asia, with packaging and board, and like in South America, Brazil, in the pulp side. Our balance sheet, when I started in this position, our gearing was 121, if I remember right, %. Today it's at a level of 40. So we have a strong balance sheet. It enables us to do things in the growth side, meaning acquisitions. When the time is right, there will be acquisition. And our balance sheet in the terms of what we have in the way of joint ventures, like Sharpen, and also in the forms that we have the ownership of Finnish energy companies, it's a very valuable asset in our balance sheet. So all this leads to the fact that we can create substantial shareholder value, and our dividend policy, 40 to 60% of our operative net profit, further strengthen that approach. Fit for Growth, 60 million euros. Already this year, 2012, we will record 10 million improvement in our EBIT coming from Fit for Growth, meaning cost savings. Not top line growth, but cost savings. Next year it's 50, and like already discussed earlier, 2014, full scale, 60 million in EBIT 10. That's what we are committed to do. If we look how these savings will come into different segments, basically, during the next 2 years, it's basically paper and municipal industrial. They will take the lion's share of the savings. 75% of the savings will be recorded into paper and municipal and industrial. Then a little bit less for oil and mining and for ChemSolutions. So if you calculate the future profit of this segment, you always have to remember that we are recalculating all the segment figures concerning this year and last year, because this so-called CEO office will be dismantled and the costs will be put into the segments also 11 and 12. So you need to take that into account, but we will provide you the, let's say, the new figures then early part next year for these years 2011 and 12 as well. So you have to break the egg to get an omelette. So that's basically the story here. In order to get the 60 million euro savings, you need to record, like we have estimated, 85 million euro cost. One-time restructuring costs, mainly relating to asset write-down, roughly 50 million euros, and then cash type of items, roughly 35 million euros. Of course, you understand that the cash cost mostly goes back to the fact that 600 people is a target that we are reducing our headcount. And the other part, the write-downs, clear the message has been that we are looking roughly to 14 different sites and plans, what we are going to do with them going further. These 14 plants is 20% of our plants. And that is now under review. And to be finalized when all these negotiations, etc., will be over later this month. Just go back to this year's and the guidance. It remains unchanged what we have announced basically late July. Both the top line in the revenues and the EBIT will be at the same level as last year. We have assumed certain things with oil price and also with the currencies, etc. But basically, the fact is that our guidance remains unchanged concerning this year. Going back to Fit for Growth overall, these issues is that Fit for Growth, since we are talking about cost savings, not just fixed cost savings, but talking about cost savings in the terms of efficiency, etc., it will address all our cost items, coming from raw materials, going to logistics, going to energy, and then the others, meaning basically maintenance, headcount, etc., etc. So 60 million will be inside of all these 4 elements that we have in our portfolio. If you look at our raw materials today, top 10 accounts 45% of our raw material spend. Last year it was 46%, so we have slightly reduced the position. But basically most of our top 10 raw materials goes back to coagulant manufacturing and polymers. So that's basically half of our cost is around those kind of raw materials what we are handling today. But this is an important slide in the terms where the 60 million euro cost savings will land going forward. When I started in this position back in 2008, there was a lot of discussion, does Kemira has pricing power in the marketplace? The organization has done a lot of work in the terms of reacting to market prices, both in the terms of raw materials and then bringing the price increases with our finished goods. And the team has done good work, like you can see from the graph. The green one and the blue one basically goes hand in hand today. And that is important going forward as the markets are still volatile. If you look at the feedstock prices today as an example, there is constant move up and down going in the background. But we have been able to shift our focus, understanding the market demand, the changes in the market, and getting the understanding to our salespeople to be able to increase sales prices. Very good achievement. Balance sheet. Everything comes into the balance sheet. That's how life normally goes. We have a very strong balance sheet today. We have really come down in the terms what our debt has been and how we are seeing our gearing during the last few years. We are stating here basically that we would like to see our net debt to EBITDA stay below 2.5, and at the same time seeing that the gearing stays in our target range below 60%. Because this is a matter of fact for us, because we want to grow, so we need to have the balance sheet that enables us to grow, but we are not entering to the area of risky business in that sense that we are jeopardizing our balance sheet. Currently our debt structure is very healthy. Last year we renewed our revolver agreement, so we have 300 million euro unused debt in the back pocket if we need to do something. But important is that we have the tools to invest and keep our balance sheet in good shape and be able also to pay dividend for our shareholders. Net working capital, cash flow. I got some question during the breaks about net working capital, how we are addressing that fact, and that is clearly an issue in today's world that net working capital is something you need to manage well in order to keep the cash flow in the right balance. We are targeting to keep the net working capital at the level of 11%. Last year we said 12, so we are strengthening our message. It needs to be 11. You all understand that there are three elements what you can do well when managing net working capital, either in the terms of inventory, meaning supply demand, how you manage your customer payment terms, and how you manage your suppliers. 11%, we have been there. We need to come back to the right level, and again, in the sake of getting good cash flow in the background. So it means a lot of things for our organization to get the supply demand, as an example, in the right balance. But we have talked a lot about here about the SKUs, stock keeping units, and how we are reducing the number of stock keeping units, and that alone helps us a lot in the terms how we manage inventories. So there are a lot of things in the background going, how we get the curve back to the right level, meaning the 11%. This is clearly a target for us. Next part of the working capital management towards the cash flow is investment, how we manage investment. As an average, we have spent roughly 100 million euros a year for investment, maintenance, improvement, and then strategic investment in the terms of new facilities or some acquisition. This year, the running rate is roughly at the level of 130 million euros, really geared up by Nanjing plant investment and also our investment in India. But this is very important in the terms of, again, looking at the cash flow management, how you manage your CapExes in order to have the one important target for Kemira. We need to have a positive cash flow after dividend. So one part is how you manage your CapEx. And over the years, more and more CapExes we have directed to emerging markets where the growth is, like Hilton and Joe explained just a few minutes ago. And then finally coming to the dividend payout and how it has been during the last few years. It has been unchanged as a policy the last 5 years, 40 to 60% of our operative net profit. And as an example, last year, 2011, based on 2011 figures, we distributed the maximum dividend 60% in April this year. And increased dividend combined with the lower gearing just tell the story. We are not paying dividends by taking debt. We have the cash flow and we have the profitability in place. Financial targets, basically untouched. If we look our targets for the last few years, the growth targets concerning the mature market, done. In the emerging markets, we have things to do, and also the Fit for Growth program address that part of the story, and like Hilton and Joe mentioned, opportunities are over there. EBIT margin, we will get the 10% through this program. Gearing is already there in the comfort zone. Cash flow has been positive after dividends. So in many ways, we have done the right things, and now we need to get the final tuning so that all these 5 targets are met. So finally, 3 things to remember, ladies and gentlemen. Fit for Growth will bring us to 10% EBIT 2014. That is the commitment, very clear. Our accessible market, 26 billion euro globally. We want to grow above the market figure, 3.4 it was the market. If we meet our growth target in the emerging markets and mature market, our growth will be higher than the market growth as an average. And finally, our balance sheet. It enables us to grow, enables us to take the right actions towards the growth and the more profitable company. So, ladies and gentlemen, that's all I had to say, and now questions if that's the case.
We'll start here.
It's Eric also from AKO Capital. You guide for an EBIT margin of 7.2% this year. Incremental savings 13 and 14 will be 50 million. 50 million over 2.2 billion is 230 bips. So that takes you to 9.5%. Where does the rest of the EBIT margin improvement come from? Thanks.
Yeah, that's a very good question. I nearly expected that kind of question, so thank you for asking the question. Because it's really, this 60 million, it's about cost savings. So we get to 9.5 using that mathematics, which is more or less what I calculated as well. That the rest we need to have the top line growth. Like we have seen that we need the more actions in the emerging market, like in Asia Pacific and Brazil, but also in the mature market. And that will bring us. So it's a margin coming from extra sales.
Just to follow up, what kind of organic growth do you need to just maintain margins? Because all businesses have some cost inflation. Salaries go up 2 to 3% every year, typically. So most businesses need 2 to 3% organic growth just to maintain current status quo. So what kind of organic growth do you need to just maintain things as is?
Yeah, it would be easy to answer that there's a certain percentage that we need in order to tackle cost inflation. But part of the cost inflation is that you need to improve your efficiency. And that's where you answer the question of how you manage the inflation. Organic growth is important, but that is part of this 3% target and 7% target what we have in our target setting. So that's the way we want to manage the inflation side.
Thank you.
Hannu, Danske Markets. Just a question on your balance sheet. You mentioned having valuable assets there, like the ownership in Finnish energy company, PVO. Do you think at some point of time you might no longer need those if you would have less paper chemical production in Finland, which is energy intensive? Thanks.
Yes, I pointed out this fact that in our balance sheet we have really the ownership of both PVO and TVO, which are our big energy companies in Finland, also Sahtleben. I didn't point that out in the fact that we are planning to get rid of certain kind of businesses. But that's something when you think about creating shareholder value, that you have assets in your portfolio that really are valuable in the terms going forward. Because this, as an example, these energy assets, they are very important as we utilize the electricity basically at cost, not at the market value. So it's very valuable in that sense, both in P&L but also in balance sheet.
Hi there, Alistair Mackey from Citibank. I was wondering whether you could provide any guidance on what level CapEx would be in 2013, particularly as your factories in China and India are close to completion now. And secondly, on the 11% guidance for the working capital, do you have an idea about how long it would take to get back down to that level?
Yeah, let's take the first one. The CapEx, like I said, it has been roughly 100 million euros per year. This year it will be higher because of these growth CapEx that we are running in Asia Pacific. It will be 120, 130 million rates probably this year. And going forward, we'll see, depending on the project that we are then putting into our project basket going forward. The net working capital 11, if you think about year-end and position, I would love to see that taking place this year, but it may take next year to get to that level. But that is a target we need to manage in order to have the cash flow then for CapEx and for other actions.
Thank you.
Other questions? If not, I think we proceed and take Wolfgang's final concluding remarks.
Ladies and gentlemen, I trust that with this afternoon we could demonstrate to you that Kemira is well underway to become an agile company in an ever more competitive global market space. In order to be agile, in order to stay agile, fitness is required. And Fit for Growth is the fitness program for us in order, first of all, to get to the level we want to be, but we will not stop there. And there were a lot of questions: how sustainable is that? How is that going to take you forward? There was the question, there is inflation, and Jyrki Mäki-Kala rightfully said, efficiency improvement is the rule of the game in the chemical industry, and there are companies who claim they have to achieve 3%, others claim they have to achieve 4%, and that means we will not stop when Fit for Growth is implemented. We will constantly challenge our infrastructure, our organizational efficiency, our process efficiency going forward in order not just to once get there now, but to stay where we are and to constantly improve. Otherwise, a company of our size has no long-term future in this market. If you see what's happening on the M&A side, there are guys with much larger pockets than ours, and they swallow companies like ours in 3 months if needed. So therefore, if we now just in one big exercise get where we want to be and then slow down again, we are losing out again. And you will see similar curves as you have seen them today in the years to come. That is what this management team will not let happen. So therefore, this is a starting point. We are now getting there, but we are doing everything to stay there and are not getting complacent once we have achieved it. We will use resources scarcely. We will not start suddenly to overspend. We will spend money where we have a return. If there is no return, we will not invest. Investing for non-profitable growth is a waste of money. It doesn't get you anywhere. And therefore, also from an investment point of view, be it CapEx, being an M&A, we have clear rules what we want to see. If projects meet these requirements, we will obviously put them into place. If they don't meet the requirements, it's better for the shareholders, it's better for us, it's better for the company not to do it. And we will also have the guts to say no if we feel that a certain project is not suitable for us because it either doesn't give us certain positions, as I explained, or if it doesn't give us the return we expect. So, in a nutshell, first of all, we now spend the next 1.5 years in the fitness studio in order to return what we have promised. In parallel, we will continue, and this is something which is very important, we will continue to leverage the mature markets. We have a very strong position there today. There is a lot of opportunities for us, and we will leverage these opportunities to the utmost we can. Because, of course, the growth rates in the emerging markets are much higher. But if you see the absolute terms, which we have today in the mature markets, even a 3% growth rate in the mature markets is a very sizable top-line growth. So therefore, we will not walk away from that focus. On top of that, we want to strengthen our position, as Hilton and Joe have explained, in APAC as well as in South America. Obviously, and this was related to South America, some of potential investments very much depend on certain projects. So if we discuss a chemical island, first of all, there must be somebody who builds a pulp plant. Without a pulp mill, no chemical island. If there is a chemical island to be built, there is also competition. As we showed in the presentation, we are not alone in the pulp market. Therefore, this is very difficult to plan in the investment plan. This is what I call an on-off investment. Either you get a long-term contract, pretty much the similar approach as you have it from the gas suppliers like Linde, Praxair, etc. You invest in something, you have a long-term business return, very sustainable, no risk, but it either comes or it doesn't come. And that means when we talk 100 million investment, this is obviously without these opportunities which we will take and participate as we deem appropriate. Continuous improvement overall will be also a key theme for the company. And I've said in many interviews, to me, the vision is a learning organization. The world will keep changing, and we see that on a daily basis. If we manage to get to an organization where we constantly try to improve from within, this is much more powerful than whatever projects you can drive from the top. And this is what I would like to achieve, that we get Kemira into a state where change is not a question of concern, but change is seen by a large part of the organization as an opportunity, because that helps us to stay ahead of the crowd. Thank you very much.